Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
been a tumultuous summer for crypto.
Bitcoin continues its descent, a $2 trillion free fall.
The biggest threat yet to its survival.
After surging to more than $68,000 last year, Bitcoin had its worst month on record in June, falling below $18,000. Evangelists believe crypto is the future of finance.
There are some businesses that I think have a really bright future.
This is a volatile, highly cyclical asset, but the secular trend is here to stay.
The overall valuations are down significantly. That's fantastic for the business we're in.
Now is also the best time to do M&As.
Skeptics say it's a digital casino built on speculation.
The value of most cryptocurrencies is zero.
It is a highly speculative asset.
It will eventually blow up. It's a fraud.
How cold and long will the crypto winter be? What does the meltdown mean for the future of DeFi and blockchain? Is the industry overdue for regulation? At the Crypto Summit, we convene leaders from coins, blockchain, NFTs, and DeFi to provide actionable intelligence. This is the Bloomberg Crypto Summit.
Please welcome to the stage Bloomberg Crypto Managing Editor Stacey Marie Ishmael.
Good morning, everybody, and good afternoon to everybody joining us in different time zones around the world, including some of my team. I see your stories. Hello and welcome. I hope you are all enjoying this astonishing view, and I don't just mean all of your lovely faces, and are excited about what we have going on today. I'm Stacey Marie Ishmael. I'm the Global Managing Editor for Crypto at Bloomberg News, so any stories you don't like, complain directly to me and leave my reporters alone. We are so delighted to have you here, whether you are physically with us or joining on the various forms of streaming that we've made available to all of you. But first, I want to acknowledge the fact that what a difference a few months makes in crypto. Couple of bankruptcy filings, bit of distress, some challenges in the NFT markets, and we're having a very different conversation from the one that we would have been having around this time last year. I sometimes joke that I joined Bloomberg News on the 7th of September, which is the same day that El Salvador accepted Bitcoin as legal tender, so I maybe have been the top of the market, but we'll hear more on that today. You're going to get a lot of amazing perspectives from all around the world and many different elements of this asset class. But in addition to the top names from everything from tokens to Web3 to DeFi, I'm sure there's at least one Bitcoin maximalist, venture capital and gaming. We also have legislators to get the regulatory perspective, which is one of the biggest topics that we cover here at Bloomberg News, and what the smart money has to say about what's next for the industry. Before we get started, just a couple of quick announcements, including a thank you to our founding sponsor, Grayscale. You'll be hearing from them a little bit later this morning. Thank you to Grayscale from Bloomberg. Housekeeping. For our virtual attendees, this is a quick IT notice. If you're having any trouble at all with either the audio or the video, refresh your browser. I'm not going to tell you to turn it on and off again, but you might, and that will definitely work. And if you're having any ongoing technical challenges, there is a little chat box that you can enter and somebody will help you get up and running. We also have the ability to submit questions virtually. I'm going to read this because these instructions are very important. If you are trying to submit questions virtually, there is a white tab on the right side of the video window. If you're in the room with us, you will have a QR code on your badge, which you will see me wear when I'm not on stage. You can scan that with your phone or your very large iPads to submit questions. We do encourage you to do that. We're really excited to make sure that we're hearing from all of you and getting your feedback, and we'll be doing our best to answer them and work those through sessions over the course of the day. We are, of course, on all forms of social media. The hashtag is #BloombergCrypto. And I have to plug our fantastic social teams. We are tweeting from @crypto as well as various other Bloomberg accounts. And that's it. It's time to get started. Enjoy the show, everybody. I'll see you again later.
Please welcome to the stage Galaxy Digital founder and CEO Michael Novogratz with Bloomberg's Shonali Bassick.
What a time to have you.
So much fun.
So if you look at everything that's happening in the market, of course, let's go back even just a couple of weeks now to the Luna situation, because that was something that you were intimately involved with, and now it's a good time to kind of look back because it hasn't been the only one. If you look back, what are some of the lessons learned?
Yeah, listen, I think Luna was the first kind of part of this crisis, and it started a daisy chain of events. And if there's a lesson learned, was that the industry, plenty of retail investors, really had very, very little concept of risk management. And listen, what was interesting about Luna was it was very transparent, right? It was all public, it was all on the blockchain. People knew if they paid attention, the bet they were making. The bet turned out not to work, and it unraveled very quickly. What I don't think people expected was the magnitude of losses that would show up in professional institutions' balance sheets. And that caused a daisy chain of effects. Companies like Celsius and Three Arrows and Genesis and blockchain.com and you name it, they're all this is all public information now, had exposure. And then the Three Arrows situation, which we'll see, if it was legitimate or if there was fraud involved, really started that flywheel of credit losses. And it turned into a full-fledged credit crisis, right, with complete liquidation and huge damage to confidence in the space, into the infrastructure of the space. 3, 4, 5, 6 big institutions either declaring Chapter 11 or de facto doing the same thing by putting up gates and stopping retail deposits from leaving. I used to say, not to be an I told you so, but I would stay with talking to industry groups. I was like, we need to self-regulate or the regulators are coming. And when you look back, there was very little self-regulation. There was inane risk management where companies took massive leverage, took asset liability mismatch, which means they had short-term deposits and they lent them out long. I mean, those are the two ways people always go bankrupt. This is a tale as old as time. And it happened in lots of ways. That's greed, that's ignorance. It's frustrating as heck because, at times the whole industry looks like a bunch of idiots. What's really interesting is the DeFi stuff, the on-chain stuff, worked like it was supposed to work. It was transparent, right? People got stopped out when they were supposed to be getting stopped out. There's no, oh, he lied to me. I can't believe that. I didn't know the rules, right? It was all on-chain. And so in lots of ways, as ironic as this sounds, this crisis is somewhat an advertisement for more transparency and more DeFi.
So if you think about what you're saying about this flywheel of effects and a credit crisis that was caused, are we still going to see much more? Is that flywheel still spinning?
I think what you saw was a cascading of stops. And so the margin losses all got hit in that move, literally from 29,000 to 17 or 18,000, whatever the low was, all at once. And I had hoped this year, 2830 would be the low, and I was darn wrong because I didn't realize the magnitude of the leverage in the system. So we had that deleveraging really fast, and after that, what you're seeing was asset disposals. And so once you deleverage, you still have, if you're a company that's gone bankrupt, you owe your creditors back the money. So if you have a pile of stuff, it needs to get sold. And so you saw a lot of that in the last couple of weeks. A couple of the big credit funds were just selling their wrapped Bitcoin, selling their ETH, selling their liquid stuff. I think lots of hedge funds are out of business and they don't know it yet. Once the redemption notices come in, people are like, you've lost 60% of my money, give me back the 40 cents. Right? I think there were 1,400 hedge funds in the space. That's up from 400 2 years ago. It won't surprise me if that number heads back to where it used to be. And so that weighed on the market and will continue to weigh on the market some as asset sales happen. But I think the worst happened. And now we're rebuilding. We've had a couple good days in a row. There's a good story with Ethereum in the merge. the global macro markets are at max bearishness, right? Like the Bank of America put out a piece today that said they haven't seen equity bearishness like this since October of '08. And so you might see a respite here for a while, though we won't get a sustainable next leg of the crypto bull market until a little bit more of this damage is healed and a new narrative emerges.
And to that end, that's an extraordinary amount of liquidations that you see coming, thousands, many thousands. And so if that is the case, how is there not more pain? How is there not more selling?
Listen, when you hit max fear, that normally is a bottom. I'm not saying 100% we had the bottom, but it feels like that was a pretty good shot at it. And so you can go for long periods of time where you have ranges. You go up a little on enthusiasm and someone has to sell it. And, that selling's not forced selling right now. And so we had the forced selling. That's the most pain. There's no more forced selling. There's no leverage in the system. And so I don't think you'll see a lot of forced selling. And people aren't going to give up on crypto. You have to remember, crypto comes from a belief that the traditional institutions are less trusted, right? Our central banks aren't responsible, that our politicians are moving to becoming populist and spending money they don't have. If you look around the world, and if you look around the US, trust is at an all-time low. We're looking at a potential election of Donald Trump and Joe Biden. People want to shoot themselves, right? And so to think all of a sudden trust is healed and we're all going to be good is insane. The Fed has a brutally difficult job. We had 9.1% inflation headline last month. We see the economy slowing dramatically. The Fed funds curve is saying, well, they're going to hike 2.5, 3 more times, and then they're going to cut 75 basis points. That's a wacky shaped curve. Jay Clayton's back there. Jay Powell has a really tough job, right? He needs to kill inflation expectations and bring inflation back heading lower, but pretty soon people are going to be screaming recession. And will he be able to land that plane? Maybe, but I think the markets will bet he's going to flinch. He's going to have to stop hiking rates before inflation really gets cemented. And then if they have to cut, you're going to see inflation take back off. And so the macro case for crypto is still there. So
let's talk about some of the central thesis, and that's trust. And to your point earlier that you made, a lot of retail investors have lost a lot of money. And in this kind of world where we're seeing bankruptcy proceedings and we're seeing, large investors versus small investors, line up for claims, some of them with a lot of money on the line, how does the retail investor get protected anymore?
Well, one of the most frustrating things is that breakdown of trust. I have a wrestling coach friend of mine that had a huge amount of his savings in crypto. Then he told me I knew he had money in crypto and he had Bitcoin, and he'd call me for advice. And then he said, it was all with Celsius. And I was like, oh, you gotta be kidding. And he said, what do I do? I was like, you broadly wait, you file your claim, and who knows what you'll get back, but you kind of write it off in your head, and hopefully it comes back and you get 40 cents on the dollar, or maybe more, maybe less. Yeah, that's absolutely no good. I think probably, the regulator, you could ask Jay, they have a tough job. The SEC under Gensler was in the offices of both BlockFi and Celsius, right? They had already made a settlement with BlockFi. But they were allowing these institutions to take a huge amount of leverage, take retail deposits in, gamble them like they were hedge funds. And so, I don't know what the SEC should have done or could have done or might have done, but they didn't do a lot to protect the retail investor in those two organizations when they were in their offices, right? And so it's a very hard thing to figure out what the right scheme should be. I think investors are going to learn to be a little more leery of who they trust, right? Even, crypto at some exchanges, is the exchange well capitalized? Do they have insurance? Can they use your crypto to be joint? I mean, what was interesting in these cases is normally if it was a retail institution in TradeFi, retail depositors stand way above the senior creditors. They get their money back first, and they're insured. In these cases, it's not clear if creditors and retail depositors are traded the same. And so that money is just almost fungible at this point. And so I think you're going to see changes in regulation. You should. And I think retail is going to be more leery. But the human instinct to want to gamble and make your life better doesn't go away. It is literally inbred in us almost. And so the moment you hit equilibrium, momentum will start showing up on the speculative side again.
To the extent that behaviors need to change in crypto, to the extent that certain things just need to be washed out, of all the things that you've seen happen over the last couple of years riding into this historic bull market, what are the things that just have to go?
I would love to see more transparency of, like with Galaxy stock, if you own more than 5% of it, you've got to declare you own more than 5% of it, and every time you sell it gets published. If you're an insider, every time you sell it gets published. If I had sold $1 billion of Galaxy stock and not told anybody about it, I'd go to jail. But in these crypto ecosystems, the founders, the founding groups, the VCs that participate, no matter what they own, can sell as much as they want, not tell anybody. And that develops a sense of unfairness. And so disclosure amongst large holders in the same way would make sense. I've actually argued many a time that if you launched a protocol, they should willingly do that. And some do. I think that would be a start. It's how you build trust with the people that you want to invest in your company or your protocol or your community. And that's a start. I think when we deal with retail, there should be more caution. Like the disclosure, I'm sure if I went on Celsius or BlockFi's website, somewhere in the fine print it says exactly what they were allowed to do. But I know because my heart doctor I saw just Friday, who lost $1 million in Celsius of all his Bitcoin and was really upset. I was like, now I'm thinking about him, I have to worry about his heart instead of him worrying about my heart. No one reads the fine print. He assumed that was like a bank account. I was like, oh, dude. And so the disclosure amongst taking retail deposits or retail should be much, much higher.
So how does that pair with then, earlier you were saying DeFi worked. A lot of your peers and rivals are saying CeFi didn't.
Yeah, it's true.
And so how then, as you see the industry evolve, how is this also just not, same industry, new clothes?
Well, it turns out there was, some reporter called me, I started singing from Beauty and the Beast, Tale as Old as Time. Tale as old as time. This was same industry, new clothes, right? The mistakes that were made in all those organizations I was talking about have happened time immemorial. Household finance with the mortgages, Lehman Brothers, Merrill Lynch, asset liability mismatch, too much leverage. And so what on-chain stuff did is you saw it right there. And that didn't mean people didn't lose money, but there was no, oh my goodness, I got lied to. No, you weren't lied to. It was right on chain. And so I do think you'll see a push towards more transparency, both in CeFi and DeFi. I mean, DeFi has it. It's complicated on how to use DeFi, right? If you're the wrestling coach from Iowa and you're not a complete computer nerd diving in or a crypto degen and you want to participate, it's difficult to figure out how to get your money onto Aave Pro or Aave or Compound or, move money from MetaMask to, that's all really complicated. And so one of the things I think you're going to see in the industry is an acceleration of better user experience, user interface, much more intuitive ways for people to invest.
Speaking of investing, I asked earlier about the washout in the industry among investors, among funds, but what about projects themselves? If you kind of have to realign the way you invest in the wake of this crypto winter, how are you rethinking your entire portfolio and what are you now avoiding?
Listen, I still think Bitcoin is really unique in that it's got a lane of store of value and that it's kind of an anti-populist asset. And I don't see politics not being populist, and populist governments spend more money than they have. And if it wasn't for Joe Manchin, we'd really be going the other direction. He's holding the line of spending more money than we have. But the Republicans, under Trump, spent way more money than we had, and then the Democrats did, and I don't see that shifting. And so I think Bitcoin continues to be an asset you need in your portfolio. The other side of crypto, in some ways the much more exciting side, right? Web3, this big blockchain that's being built, which will, I think, be based around Ethereum, but Polygon, lots of other players will have a piece of it, right? Ethereum will never be the blockchain to solve all solutions. It will be fast enough. Have this modularization of blockchains. It becomes a pretty technical bet. Trust the professionals in some ways. That's not going away. It really isn't. What I think is more unique is what gets built on top. In that case, one of the mistakes I think this industry made, and whoever interviews Jay can ask, because the regulatory environment isn't clear, a lot of protocols built governance tokens or token economics to kind of weave their way through not being seen as a security and being a utility token, and so not being able to be regulated. That wasn't necessarily the right thing with hindsight, right? Tokens should be intuitive to the investor on, hey, if I invest in Uniswap and everybody's using Uniswap, which is this beautiful decentralized exchange, I should profit somehow directly. It should look more like a security token than the governance token of Uniswap now. Or when I think of things like the B&B token, right? CZ's token, which he was able to pay all his employees in, which is kind of a miracle. You were able to buy it originally and get a discount on the brokerage fees, but it was really used as a proxy of equity. If they made profits, they would burn some of the supply. You didn't get any of the profits that you would potentially, create this derivative, not even linked derivative. That's kind of a BS token economic system that won't survive the test of time. It becomes it would be like the Novo token. You invest in the Novo token and you get to come and have lunch with Novo once a month if you own the token, and after one lunch people are bored of it and they're like, so people will own the token but they would never take up the lunch. No one used, I shouldn't say no one, very few people used the token of B&B to get that discount. They morphed their token into more of a blockchain, and it's become the third or fourth biggest token. I'm not bad-mouthing it, but the token economics weren't clear. And I think the next chapter, we're going to have token economics that make more sense to people, that I can be able to explain them to somebody really clearly. And that's just not the case.
I could ask you about 1 million tokens. We only have a minute or so left, and so I do have to go back to some of your own predictions, and that includes for Bitcoin. You've told me very recently that you still think, within the last couple months, that you think that Bitcoin in the next 5 years or so can get to 500,000.
I do. Listen, this is a story about two things. It's about adoption and it's about global economics. And while this is a bump in the road in adoption, it's certainly not a U-turn. We continue to see institutions in Europe, in the Mideast, in the US, who haven't gotten involved yet looking at this as an opportunity. And they're not diving with 2 feet right now because people that work in institutions are a little more cautious. But once we get balance, once we get equilibrium and start a new narrative, they'll be back. And I just don't see, when I look at the global landscape between Europe, Japan, the US, China, how fiscal prudence gets put back in a box. We have debt to GDP over 140%. That almost never ends without a debt restructuring or a hyperinflation, right? Listen, we had 9% inflation this year, so they did a pretty decent job of taking 9%, or 3% rates, 9% inflation, you take 6% off the debt. You need to do that for a long time, and people get really angry when you have high inflation, right? You see what happened in Sri Lanka right now. I mean, that's an extreme case. But so we're in this really tenuous environment. When I think about it, this is the golden age of macro starting. This was the first year. Like my old job being a macro investor, I can't think of a better job to have for the next 5 or 6 years.
But what has to change? Has your timeline changed at all? Because you have to add $480,000 of value by 2027 to get to where you are saying, and overlaying that with the fact that risk-taking is going down, the Federal Reserve is tightening and not...
Yeah, but the Federal Reserve is tightening, but we'll see how much more they can tighten before they break the back of the economy and have to start cutting again. So my point is, you take a longer view, how do you get 140% debt to GDP and forget what it is in Japan and in Europe back to sustainable levels without bankrupting your grandkids? The only way you do it, there's only one way, is inflating your way out. And so hard assets are going to win. Now, Bitcoin's not the only hard asset. Gold, real estate, REITs. There are plenty of hard assets you should have in your portfolio, but Bitcoin is a unique one, and it is gaining adoption. And so I was kidding, like I've been talking the Bitcoin story for a long time. It's time to pass the torch to some other people that really know how to tell the Bitcoin story, but there will be a generation of people that really believe in this, that are convincing their friends and their communities and their institutions that this is a good way to store wealth, right? It is very unique, and there are only 21 million Bitcoin that will ever be made. It is tailor-made to being an anti-inflation store of value. It is easily transferable. And so it's better than gold in so many ways. Now I sound like Michael Saylor. And so when I say it's adoption, it really is people telling that story and getting people to believe it. That's what creates stores of value. That's how gold became gold. Gold is still a $9 to $10 trillion asset. You take all the gold in the world and it broadly fits in this room. That's ever been mined. A little bit bigger than this room. Think about that. That's $10 trillion. It would be like a sculpture. Gold is only valuable because we say it's valuable. It's the same way Bitcoin is happening, and it's happening because of the network effect of the internet, of community, of how fast information goes. But I don't think that goes backwards.
Mike, thank you so much for your time and helping us see through the noise. I hope you guys enjoyed the rest of the conference.
Thanks, guys.
Please welcome to the stage Bloomberg's Alison Verspreel.
Thank you for the introduction. As the regulation reporter for crypto, you can imagine it's been a pretty busy year. Volatility in the market has brought to light fresh concerns and new proposals for safeguards. One of the most talked about efforts is the bipartisan bill introduced in Congress to create a sweeping framework for crypto assets and significantly expand the oversight powers of the U.S. derivatives regulator, the Commodities Futures Trading Commission. Just days ago, I spoke with the co-authors of the legislation, U.S. Senator from New York, Kirsten Gillibrand, and U.S. Senator from Wyoming, Cynthia Lummis. I started by asking them, what's next with their bill? I wanted to know if they could see the whole package or parts passing anytime in the near term, and this is how they responded.
From the Ag Committee, we have an opportunity. The chairwoman and ranking member are finalizing their bipartisan part of our bill. So their part would be the CFTC jurisdiction part. And because that is bipartisan, because it is going to have time within the committee, there's a possibility that we get to vote on that piece by the end of the year. And Cynthia might have some pieces in banking that she might be able to get pushed forward. Why don't Cynthia speak to that?
Yeah, that's right, Senator Gillibrand. The part that could go through banking this year is the stablecoin part. Senator Gillibrand and I have components on stablecoin in our bill that relate specifically to how banks could issue stablecoins. Senator Pat Toomey from Pennsylvania has a bill that would address how non-banks could issue and what requirements would be made of them should they choose to issue stablecoins. So that's something that could go through the banking committee this year. I think both Kirsten and I believe that the bill in one piece as a total bill is more likely to be deferred until next year. It's a big topic. It's comprehensive, and it's still new to many U.S. senators. And so it's a lot for them to digest with the few remaining weeks we have in this calendar year to digest such an enormous topic.
Well, and how do you see, you mentioned the bill that Senators Bozeman and Stabenow are working on. I also know House Financial Services is working on their own stablecoin bill. I mean, do you feel like everyone's melding on this? Do you feel like there's agreement that can be reached between Democrats and Republicans on these different issues?
I do. I think for those who have begun to study the issue, there seems to be some serious common ground forming. And just as Senator Lummis said, the two committees that have the most focused senators on this topic right now are banking and ag. There's also some focus on the Finance Committee. Senator Wyden's staff and his committee wrote a good part of the tax provisions in our bill. So they had already been spending time and effort clarifying what the tax oversight would be. And so that's always something that could possibly move forward on its own timeline as well. The other piece is the cybersecurity pieces. Our bill just creates a study with NIST and CFTC and SEC to come up with cyber standards. That's something that could move forward in and of itself as well. So I also sit on the Intelligence Committee. And one of the things that Senator Lummis and I have done over the last several weeks and continue to do is we are meeting with our colleagues, and we are not only socializing the bill with their staffs, but we're taking them through the actual meat and bones of this legislation. I had the benefit of meeting with some of the Democratic members on the Ag Committee last night with Chairman Benham, and we talked about a lot of the details about why it's important, what pieces the Ag Committee has jurisdiction to do, and it was a really fulsome and thoughtful conversation.
And I likewise have been doing the same thing with members of the Senate Banking Committee, as well as some of the members of the Republican leadership. So my banking committee discussions have been bipartisan, but I also want to include Republican leadership so they have an idea of how far along we are with this topic, how fleshed out it is, who has weighed in, what kind of comments we're getting, and what kind of timelines we see. The same topics we're discussing right now. I would add that on the House side, Maxine Waters, who chairs Financial Services, and Patrick McHenry, who is the ranking Republican on that committee, we understand are getting near an agreement on some of these issues as well. So even on the House side, they're coalescing on some bipartisan policies that then we can share when we see what the House's thoughts are and they put them on paper. Senator Gillibrand and I have our thoughts already memorialized and filed so we can begin to meld our thinking on these topics.
Well, do you imagine you're going to get more co-sponsors on your particular package, or are you seeing your package as maybe a starting point that builds into these other, discussions with some of these individual bills we might see coming up in the next couple months?
I personally have not spent time asking for co-sponsors because, as Senator Lummis has said, this is a very broad and full bill that very few members of the Senate have the time, interest, or investment of understanding of all components of this bill. Cynthia and I, we are rare in this way. We've really delved into this area to become subject matter experts. And there's not many others that have expressed interest in doing that. There are a couple. Cory Booker, for example, has spent a lot of time on it, and he's going to be one of the co-leads for the agriculture portion of the bill. And so he would be somebody on the Democratic side that might want to become a co-sponsor of the full legislation. But our focus so far is really just going through the nuts and bolts of what blockchain is and what digital assets do and what the different types of business models have been created to date so that they can begin to familiarize themselves with the landscape and why there's 4 committees of jurisdiction and why this is something that's so urgent.
And in the case of the banking committee, if it were to choose to move the stable coin component of our big bill, Senator Toomey and I could meld that component of his bill and mine together, and the member of the Democrat Party who is going to be the lead co-sponsor of that, who is on the banking committee, is Senator Sinema.
Got it. Well, and you talked a little bit about urgency. I'm curious, we've seen a lot of turmoil in the crypto markets of late, most recently with the bankruptcy of Celsius. And I'm curious how that's impacted your views of your legislation. Do you feel like there are any changes that need to be made? And also, how has that impacted the conversations that you're having with other lawmakers? Do you feel like there's more urgency to do something now?
I think we both do. Go ahead, Kirsten.
So most of my colleagues were fairly alarmed with the different market impacts over the last couple of months. And the number one question is, does this regulation either prevent that or improve transparency and accountability? Does it improve safety and soundness? Does it improve consumer protections? And obviously the answer is yes. That's why we wrote the bill. And so there's additional interest now because they've seen that this is something that's important to do, that consumers are not being protected today. There's no oversight and accountability, and there are no rules of the road. And so there's more urgency now, and also more of a sense that this is something we need to do, and it's timely.
And in the case of the bankruptcy, there was not even an understanding on Capitol Hill of the difference between a payment stablecoin and a algorithmic stablecoin. In the case of a payment stablecoin, our bills would provide that they either be issued by an FDIC-insured banking institution or 100% asset-backed by hard assets in order to prevent a run on the stablecoin and hence a bankruptcy like we recently saw. So I think there's a comfort level forming among people who ask us, how would your bill address these issues? And we have answers. And people can see that if our bill were in effect today, that there would be a way to address some of the problems that were created and that failed to protect consumers when this market is running without a statutory framework or regulation.
Well, and I guess for my last piece of my question, we have a few minutes left here. I did want to talk a little bit about the feedback you've gotten so far. You kind of hinted at that at the beginning of the conversation. But one, you put your bill on GitHub, which is pretty different. So maybe you could talk about why you made that decision, how you felt that experience went. I know you closed comments recently. And then also, I'm curious, in talking with other lawmakers, with government officials, what pieces of the bill are people really coalescing behind? And are there any pieces that have kind of bubbled to the surface as needing maybe some changes?
Well, the GitHub experience has been fabulous. The decision was made to use that platform because, then the bill is apt to be seen by the very industry experts that we want to hear from. And that has, in fact, been the case. We've gotten great feedback from stakeholders, industry experts who have taken the time to access the bill through that format and provide us feedback.
And then I get to my second question. I mean, in talking with other lawmakers, getting some of the feedback you've gotten already from government officials as well, what are the areas that people are kind of coming to agreement on or coalescing around? And then are there any parts that you do think may need to be modified a bit?
So far, I haven't heard any comments that would have me change the bill as of today. There's definitely consensus that Bitcoin is a commodity, and the question of what else qualifies as a commodity and what else qualifies as a security, we have a pretty robust definition that we worked with SEC staff on, and we worked with industry experts on to make sure we really refined that definition so there could be clarity. I think where the debate will be is which fits into which definition, but that's exactly what we want the regulators to do. And we create the framework and the process to do that. But for the rest of the bill, we stay silent on 3 or 4 things where we push it to a study. People have opinions on which way to go there, but again, we didn't find consensus yet on that. And so that's why we asked for studies. And people are beginning to really try to be heard on the issue, which is great. And I think our comments process has been really fruitful.
And with regard to getting feedback from regulators, one of the things that we hope to learn is, does anything in our bill alter their current authority or create unintended consequences or openings for the traditional types of assets that they're dealing with, because we are creating new legislation specific to digital assets. And I know now that our bill has been filed. It has been referred to the Finance Committee. It's out there for the world to see, that we can expect regulators to look at our bill through the eyes of their current challenges in regulating traditional assets, just to make sure that there are no unintended consequences that would thwart their ability to regulate traditional assets that they are dealing with.
All right. Well, it looks like we are just about out of time. Thank you both for joining me today. It was a great conversation as usual. I look forward to see what happens with this bill going forward.
Thanks a lot.
Thank you. So do we.
Please welcome to the stage Coinbase head of U.S. policy, Calvert, and former SEC chairman and Fireblocks advisor, Jay Clayton, with Bloomberg's Alison Verspreel.
Didn't even give you guys time to miss me. Well, thank you for joining me today, Kara and Jay. I appreciate it. So, I wanted to kick off the conversation talking about something that's high on everyone's mind. We've seen a lot of turmoil in the crypto markets over the last couple weeks, crypto firms filing for bankruptcy, the collapse of a popular algorithmic stablecoin. And so I want to ask you about how regulation fits into all of this. Do you think there is anything that regulators could have done or should have done to prevent some of these failures?
Sure. Thanks so much, and thank you all for having us. Really appreciate it, the opportunity to speak about regulation in crypto. I think the lesson that's learned from this is that if we could create a regulatory framework that actually provides some consistency, whether it's disclosures, whether it's understanding what kind of assets or businesses are being looked at and being built, that it would give not only customers, but give other businesses, other investors more certainty on what's happening. And I think that transparency is really important. And so what we are very hopeful and optimistic about is that we will see a regulatory framework come together. And I think Senator Lummis and Gillibrand are doing a lot of work to do that at the legislative level, but what we're really hopeful is that the regulators will also come to the table in a transparent way to actually create some of those consistent measures across the board for really the life cycle of digital assets.
So, okay, let's just back up a little bit. What we saw in the past couple of months is really not something new. It may be new to the digital asset space, but the phenomenon of lots of leverage, a price correction, and a washout of people who are over-levered or don't have sufficient capital or liquidity
is not new. So we're seeing that, and those things are important. We know that in any kind of financial asset, capital, liquidity, leverage control, these are age-old lessons. So we got that. One of the things that I think is important about regulation of digital assets is to look at the etymology, the genesis of digital assets. They came about in a different way from most financial innovations. Most financial innovations are domestic and institutional. Digital assets are global and largely retail. That has presented a regulatory challenge that we really haven't encountered before, which is trying to have global coordination across a new type of asset class at the retail level. So I think if you think about it that way, you understand why there's some challenges.
Well, and I guess what makes this moment maybe different than what we've seen in the past, even with just the crypto market. I mean, we've seen crashes before. We've seen bankruptcies before with Mt. Gox. So I'm curious how this is different, and if you think there is more will this time around to actually get something done.
Go ahead. Look, let me follow up on that with your very good question, which is while let's just use the analogy of securities, or we can use banking, whichever you want. While securities look to trade the same globally, a stock here versus a stock in Hong Kong versus a stock in Shanghai, they actually are regulated differently. And that is one of the challenges that comes with digital assets, because it is a very global market with what I would say is quite different legacy regulatory approaches. I used to always say to people about investing in equities in the US, you have a pretty good set of rights. Somebody defrauds you, got a chance to get it back. There's generally a receivership bankruptcy code that's well understood. Most other places in the world, investing in equities, your chances of getting anything back in the event of bad behavior, substantially lower. And that's part of what we're seeing evolve in the crypto space.
To pull on the thread a little bit about the kind of the international scope, I think there are a lot of countries that are actually looking at this, and I think where it's different is we're at the ground level of some of the policy making, right? It is novel, it is new, the technology is eliminating intermediaries, it's changing market expectations, consumer expectations. So governments across the world are all looking at how to actually address these issues. In the United States, we're still the best place to do business, and so I think what we're trying to figure out here in the United States is how do you create a system that can understand the technology, so get a base level line of understanding of the technology, and then how can you create a system that affords the really the benefits of blockchain technology and crypto, and it doesn't kind of limit that in its infancy, but can really afford the benefits, 24/7 settling, the ability to interact at a retail level and not have to go through intermediaries, the ability to make sure that there's an immutable record. All of these benefits, we have to figure out a way to regulate it in a way that affords those benefits while still protecting the legacy consumer protections that we've done for years through the regulators in the United States.
So I completely agree. And your interview a moment ago, I think the bill that was dropped is an extremely responsible effort by both senators, because they're focusing on some of these key issues like custody, resolution, those things that are fundamental to the regulation of any market. They're saying, look, let's have a coordinated approach to those. So I want to say I applaud them for their effort, and particularly looking for feedback on what they're doing.
Well, and speaking of custody, so we have seen some regulation on this front too, not just maybe the legislation that's been proposed. The SEC, your former boss, actually put out a staff accounting bulletin 121.
My former boss?
Your former employer, I guess. Sorry, former employer.
Quote of the event.
I guess now.
And so, there's been a lot of chatter about that. In particular, it would require public companies to treat crypto that they are holding on behalf of clients as liabilities on their balance sheet. And so I wanted to get, I know Coinbase has weighed in a little bit on this in the past, so I wanted to get both of your thoughts on that.
Yeah, the staff accounting bulletin, I think, that came out in a process that certainly impacted Coinbase as a public company, impacted a lot of different public companies, a lot of financial institutions. I think what we would most like to see come out of this situation is actually a public process that's transparent, that allows stakeholders to weigh in on how something like the staff accounting bulletin might impact consumers, businesses, other stakeholders. I think that's really the missing piece here as we think about what the next step is in the regulatory environment, is making sure that we have a regulatory process, a proper rulemaking process that can actually set out some of these concerns, and then what are the risks, and then what are the solutions to those risks?
Yeah, so I think somebody in the audience will tell me if I'm wrong. I think what you can look at the staff accounting bulletin is doing is taking an extremely conservative position with respect to the custody of crypto digital assets, and in terms of accounting, which is different from whatever the rules around effective custody are going to be. And like I said, I think that the bill does a very good job of saying, look, we should try and move toward a technology agnostic definition of appropriate custody across our securities laws, so that whatever the instrument is, if it's in tokenized form, there is a way to custody it that is akin to, and at least as good as, the traditional method for custodying securities. I think that's what's on the table, and if that is resolved, the question is, will the accounting advice from the staff change? That's sort of where I see things playing out at the moment.
Well, I want to switch gears a little bit here. I know, so Kara, you had mentioned what's happening on kind of the global front. We did see the EU agree to MiCA, the Markets and Crypto Assets Framework. And we have seen the Financial Stability Board say that they want to put out a proposal for sort of robust crypto regulation in October. I'm curious, do these efforts suggest that the U.S. is falling behind when it comes to regulating digital assets?
I think the short answer is yes. We are certainly, as we look at the opportunities that are being afforded in other countries, whether it's just the market opportunities, but also regulators who are really coming to the table to understand again what the technology is and what it can do, and how we need to have new thinking and a new framework and a new way to address some of these capabilities and these benefits. I think we are falling behind, and I think what the President's executive order actually talks about that, and the Department of Commerce is actually charged with how do we make sure that we continue to lead in this space, and how do we make sure that we're competitive on a global landscape. I think that's one of those pieces in the EO that's really important that hasn't been discussed a lot. Oftentimes it gets left behind when we think about the regulatory landscape, and maybe they go hand in hand. They almost certainly go hand in hand. But staying competitive, the United States is known for being the birthplace of really innovative technology. We are already the birthplace of blockchain and of crypto, and yet we don't have to be born and raised here, right? We can move elsewhere to actually go and spread our wings. So, sorry, I just talked to my 102-year-old grandmother. I'm thinking a lot about growing wings and things, so sorry.
Now, let me take a slightly, I'll just say, different or nuanced perspective on that, which is, some people say and go, we're falling behind as a plea for deregulation of our traditional approach. I don't think that's going to work, okay? Now, where would we be falling behind, and where do we have to focus as regulators? Are we entrenching what I would say is legacy technology rather than embracing new technology that can do the regulatory job at least as well? So when people come to me and say, how should I approach regulators about this falling behind issue? I say, if you're going in and saying, look, this technology is so powerful, it's so efficient, it does so many things that you should loosen your regulation to accommodate it, that's a losing argument, okay? If you go in and say, look, this technology is so powerful, provides so many different degrees of flexibility and information that we can do the regulatory job at least as well. And in fact, better. That's something that regulators will embrace. And that's why I was very happy to see the focus in the executive order. And I think Eric Peters is going to speak later. We've talked about this a lot. On stablecoin, that is a very safe space for regulation and for regulation to accommodate new technology. It's demonstrably effective. We see tons of stablecoin transactions in number and in amount taking place every day, globally, 24/7, without significant frictions, particularly for a new innovation. This is something where regulators can embrace that across our payment system and say, look, this technology looks pretty good and can do the old job at least as well. So, as you incrementally adopt technology in a regulatory environment, you generally go to the safest space, and that's a pretty safe space.
Well, and do you think there are any ways that these efforts that are happening abroad, should they be informing what happens on the U.S. side, or should we be taking lessons from them, or should we be doing completely our own thing?
No, I think, look, as a regulator who regulates within your jurisdictional authority, but in a global market, you have to be cognizant of what goes on around the globe. Absolutely. I mean, right?
Yeah, we've thought a lot about the global best practices, and I think we've adopted some ideas because, again, we're a global company. We have to operate in many, many jurisdictions, and we have to comply with all of the different rules and regulations in all of those different jurisdictions. So it's really important that we get some harmonization and that we understand, again, that there's a consistent and level playing field, not just for Coinbase in different jurisdictions, but for all the different companies that are operating. So they're all adhering to the same high standards that the United States is known for. And so we really think that there are global best practices that we can adopt worldwide. In the United States, though, we're different than a lot of other countries, right? We have a fractured, or maybe I don't want to say fractured because that sounds like it's inefficient or ineffective. It's actually just a bifurcated system for regulation. And we also have states that are involved. We have 42 money transmission licenses. We have a BIT license. We have a trust charter. We have all of these we have regulators at the federal level. So it's not just about harmonizing globally, but it's also about creating consistency in the United States and determining how best to achieve that new regulation. I do think the crypto community is different than a lot of other industries, right? We actually are going to regulators, and I've been working with Coinbase since 2016. Since 2012, we started talking about how we wanted regulation. You don't hear that from industry very often. Actually going to regulators and saying, please give us a framework that will actually unlock innovation. It's very, very unique.
Well, and how do you think the U.S. is doing so far at this point with all of these competing priorities? We have consumer protection, we have privacy, innovation, leadership. Even the administration has talked about some of these in their executive order. I mean, how would you rank the U.S. at this point from a regulatory perspective?
That's like giving yourself a grade, right?
Yeah, it's like giving yourself a grade.
That's look. You have to look at it this way. I think the U.S. and I'll go back to what I said at the beginning. The U.S. has the most investor and consumer-oriented financial regulation on the planet by a wide margin. And it doesn't matter whether the product is securities, whether the product is loans, the product is some other consumer-related thing. That's where we are. It has developed over time, as Kara mentioned. It's developed largely in response to failures, where we felt like we failed investors, felt like we failed consumers. In that environment, where you have, like I said, an innovation that is global, not domestic, and is retail, not institutional, I think people are doing pretty well trying to get their head around it. I don't think it was recognized that that was a new type of innovation, which makes it a little bit more difficult. But I also think that Kara said that the industry, and I think there's a tremendous number of responsible players in the industry. There were irresponsible players in the industry. I mean, the ICO or ICO or whatever you want to call it, that was garbage. That was absolute garbage. And regulators have to respond to the garbage first. That's the job.
Ditto. All right. Well, some things are garbage. That's I guess the takeaway from that.
Raise your hand if you made super normal returns in an ICO. Not selling it, buying it.
Well, and I do want to get to, from an industry perspective, from someone who's been on a former regulator, what are your predictions of what's possible in the next couple months? We have the reports from the executive order. We have some of these legislative bills that have been introduced. What are your predictions?
Well, I'll tell you what I'd love to see. I would love to see clarity around stablecoin. What stablecoins are not securities, what stablecoins are effectively functioning within a permissive regulatory net across U.S. financial regulators. I'd like to see clarity around custody, because I think as we get clarity around custody, you can get clarity around things like resolution and what rights people have in the event things go wrong. Beyond that, I don't look too far out into the future, but I think those are places where progress can be made for the industry and for regulators.
Yeah, I think that there are a lot of opportunities within the next 6 months, and I completely agree. I think stablecoins is actually an area where there is agreement is coming together, and I think that really interesting thing about crypto, but stablecoins in particular, is the bipartisan nature of stablecoins. It's something that I think Republicans and Democrats can understand the value and the benefit of having a payment system that is really efficient, is immutable, is good for consumers, and so I think we could see both a legislative approach and potentially even further administrative action on this in terms of regulatory efforts. So I think that is one area where I'm very optimistic that we'll see some sort of activity. I think more largely the legislative proposals that are out there, I think it's really laying the foundation for what may happen in the future. These are really complicated issues. And as you see from the Lummis Gillibrand bill, they have a lot of different pieces in there because this is complex. It touches lots of different parts of the government, whether it's tax, whether it's the CFTC or the SEC or all the rest of the different prudential regulators. There are a lot of different issues here. And so how you piece all those together in the legislative process takes a lot of time and a lot of expertise. And so that's what's being built, and those are the foundations that are being laid now. I am very optimistic that we will see legislation moving forward and actually getting across the finish line in the next year or so. And really applaud actually not only Senators Gillibrand, but a lot of the other members who are putting in the really hard work to come and talk to industry, to talk to consumer groups, to talk to other stakeholders about how crypto is impacting not only their voters and their communities, but how it's impacting the economy at large.
I guess we'll see. It's you might be more optimistic about Congress than a lot of people I know.
That's what happens. Eternal optimist here.
But you want the steps that unleash the power of the private markets, and our payment system is at the core of all financial transactions. There's always a payment leg, or at least usually, and if you start to get that right, then the opportunities for digitizing, tokenizing other instruments, whether traditional instruments or new, are significant.
You raised a really good point that I would just also mention that I think when we start to talk about things like tokenized securities and other new products, one of the things I think that's really important, and I know I've said this and I sound like a broken record, but having a transparent rulemaking process, we are very hopeful. I think that regulators engage in that kind of transparent cooperation and communication with different folks in this landscape, because that actually, again, will also lay the foundation. These types of rules can't be done in a black box. It's really important that they engage everybody else.
Well, and with our last couple minutes here, I do want to ask, we had a poll that was on the screen a second ago, and we had asked some folks on Twitter what they thought the biggest regulatory issue facing the crypto industry was in the near term, and overwhelmingly it was SEC enforcement. I wanted to get your thoughts on what we've been seeing from the SEC, what we've been hearing from Chair Gensler. Do you agree that this is?
I feel like this should be your question to start with first. I will be happy to follow this up.
Look, there has been a lot of activity in the securities markets where the securities laws have not been followed. And the extent to which the SEC is going to enforce its laws is obviously a part of this. I do think that will pass. That phase will pass. People will understand that the definition of the security in the United States is extremely broad. If you're raising money for a venture, you should assume it's a security. That's why we have public and private markets. We have a different approach from most places. It's extremely broad. If you don't want to comply with the public offering rules, there's the private markets that you can access. They're robust. I do think that the most important thing will be legislation that unleashes the technology, or clarity from regulators, or realistically a combination of both that unleashes the technology across the spectrum of products. That will become that issue will come to the fore in my view.
Yeah, and I just think that if we have enforcement actions, I think it's really important that we, hand in hand with enforcement, that we don't regulate by enforcement. That we actually, if they're going to have enforcement actions that are justified, we also need to understand what the rules are and how we can maybe use new way of thinking in some of these different spaces. And again, enforcement is going to have to go hand in hand with regulatory clarity, transparency in rulemaking, and really a cooperation and an open dialogue. And we've had that open dialogue with a number of regulators, but continuing to have an open dialogue in order to get to an endpoint that makes sense.
Well, it looks like we are just out of time, so this was a fascinating conversation. Thank you both so much for joining me.
Thanks. Thank you.
Grayscale Investments is the world's largest digital currency asset manager. We pioneered and have been the catalyst that has gotten many investors involved in digital currency related investments. As we think about the future, we're really excited to continue to expand our product family to ensure that we're always not only meeting investor demands, but actually creating demand that investors need in their portfolios.
Please welcome to the stage Grayscale Chief Legal Officer Craig Salm with Bloomberg's Michael Briady.
Thank you everyone for joining today. My name is Michael Briady. I am an FX and crypto specialist here at Bloomberg. Joined today by Craig Salm, Chief Legal Officer at Grayscale, as Grayscale is one of our sponsors for this program, to talk about the spotlight, ETFs and Bitcoin ETF that they've been working on right now. I'd like to thank everybody for coming today. Craig, we only have 8 minutes here. This is like a commercial during the Super Bowl, a very good commercial during the Super Bowl.
We just saw really good.
Yeah, exactly. So we'll get right into it. The SEC recently denied your application. Can you give us some updates on where we stand right now?
Sure. So just to level set, Grayscale is the sponsor of Grayscale Bitcoin Trust, ticker symbol GBTC. It's the largest publicly traded Bitcoin fund in the world, represents about 1 million investors across all of the US, has tens of billions of dollars of AUM, trades tens to hundreds of millions of dollars of trading volume. However, today it is not a spot-based Bitcoin ETF, which is what we believe to be the most efficient way to get Bitcoin exposure. And so last October, we filed a form called a 19B4 with the SEC, which is the application to convert GBTC into a spot Bitcoin ETF. We specifically did it on the date that we did because that was the same day that the first Bitcoin futures ETF started trading in the US, which was a really important event because it's just bringing more access and exposure to Bitcoin for US investors. What that process did was kick off a 240-day standard review period where the SEC invites the public in to submit comment letters expressing why they believe or don't believe the SEC should allow spot-based Bitcoin ETFs. During this time, we kicked off a national campaign across the US to really activate our investor base primarily to let them know they could be a part of this process. But through that campaign, we saw letters come in from academics, from trade associations, from policymakers, from market participants, like authorized participants that would support the ETF, all with very strong substantive arguments. We also actually broke a record for most letters submitted to the SEC for rule change. It was about 11,500. And that's just a reflection of how important and significant this particular product is. And so during the course of that process, letters came in. We were really encouraged by that support. But ultimately, we found out a couple weeks ago that we were denied in our application. And as a result, we filed something called a petition for review, which challenges the SEC's denial of our Bitcoin ETF application. And what that challenge really comes down to is something super simple. You have two types of ways to get Bitcoin exposure: through Bitcoin futures or through physical or spot Bitcoin. Both of those methods are deriving their pricing from the same underlying spot Bitcoin markets. And so if you're okay with an ETF that holds Bitcoin futures, you should also be okay with an ETF that holds spot Bitcoin.
So was this lawsuit your only course of action?
So this is something that's played out over many years. Back in 2016 and 2017, you had really the first wave of Bitcoin ETF applicants, both for futures and spot-based ETFs. And at that time, the SEC had concerns around things like fraud or manipulation in the underlying Bitcoin markets. And given that concern, they denied or told to withdraw all types of ETFs, which makes sense, again, because they are priced based on those same underlying markets. We pulled our application and then later last year refiled because of that event around the Bitcoin futures ETF. So this is something that's been going on for a long time. We and other peer firms like Grayscale have engaged with the SEC to help resolve some of these issues. And we got to a point a couple weeks ago where we received a final denial order. And so we were left with a choice. We could either do nothing and continue to operate GBTC as is, but we don't believe it's our fiduciary duty to do that because these investors both want and deserve a more regulated Bitcoin investment vehicle. So we were at a point where we had, essentially exhausted all resources except appealing to the judicial branch, and that's where we are now. And really focused on explaining our arguments, which we think are very straightforward and compelling, and looking forward to engaging with the courts on that.
Yeah, it seems so healthy for the market to get this sorted out.
Right. I mean, if you look at other parts of the world, Australia, Brazil, Canada, I'm going in alphabetical order, Europe, they all have spot-based Bitcoin ETFs and other cryptocurrency ETFs. And those are markets that have robust securities regulations. So the question is, what is really holding us back here in the U.S.?
So from this point on, what does the timeline look like now?
Yep. So that's a very common question we get around timeline. One important thing to note is because we're challenging a decision from a federal agency, rather than going to the district level, which is the first tier of the federal court system, we bypass that level and go straight to the appellate level. So that saves a good chunk of time. Based on discussions with our counsel, we're hearing at the appellate level anywhere from 9 to 12 months, could be shorter, could be longer. Litigation isn't inherently uncertain in terms of timing. But right now, we're just laser focused on drafting our brief, which is the written substantive arguments that we'll be presenting to the appellate court. And again, what it really boils down to is something super straightforward and simple. You have futures ETFs, you have spot ETFs. They both derive their pricing based on the underlying spot Bitcoin markets.
Sounds simple.
So if you're okay with one, you should also be okay. I completely agree.
So you're in a lawsuit with the SEC basically right now. So is that going to hamper your relationship right now? I mean, I read a lot of the press. It's not really like there's an argument. This is more of a disagreement.
Yeah. So I have nothing but respect for the individuals at the SEC who for years have been grappling with the important and challenging questions presented by digital assets, of which spot Bitcoin ETFs are but one. We and other firms have been in conversations with them, working through these issues around crypto. How is it used? Where does it trade? How is it priced and custody and things like that? And we're just at an impasse where we have a disagreement on how the regulations that would allow for Bitcoin ETFs to start trading are being interpreted. And so when you have a situation like that, because we have a system of checks and balances, we have the judicial branch that you can appeal to see if they will interpret the rules and regulations the way you believe they should. So it's very much a respectful relationship and not something that has anything to do with any sort of ill will or anything between market participants and regulators.
It definitely seems like a fair challenge for sure. So what happens if they come back and they continue to deny?
Yeah, so right now, super focused on setting up our brief. There's also an opportunity where those that have an interest in the matter can submit something called an amicus brief. And what that is a friend of the court in Latin, and it's for those that have a view that they think would be important for the judges to receive and also work through the issues. So focusing on that, building out our strategy with Don Verrilli, who's the former Solicitor General under Obama, who's the senior legal strategist on this matter, and then also our lawyers at Davis Polk, and we're taking things from there.
And if they come back, well, when they come back and say that you're approved, what happens then?
So the way it would work is a victory on our side would mean that we can no longer be denied on the basis that we've been denied, as well as all the other spot-based ETFs, and then it goes back to the SEC, and then we go through that process.
I like the victory. It sounds good.
Yeah.
Craig, thank you for your time. I appreciate it. Everybody enjoy the rest of the show, and thanks again.
Please welcome to the stage Uniswap Labs COO Mary Catherine Lader, Block Chairman and Co-founder Matthew Rozak, and Ava Labs President John Wu with Bloomberg's Emily Nicole.
Hello, everyone. Well, in my opinion, this is going to be one of the most interesting panels that we've got going today. It is going to focus on DeFi and whether or not it can weather the crypto winter that we're currently in. DeFi has certainly had a rocky year, starting off with the collapse of the Terra ecosystem and pushing ahead to now where we're really seeing the focus on centralized lenders. But to introduce some of the panel we've got here, I wanted to actually invite them to do that themselves because they know crypto better than I do, I'm sure. So Mary Catherine, why don't we start with you?
I'm Mary Catherine Lader. I'm COO of Uniswap Labs, which developed the Uniswap protocol, which is the largest decentralized trading exchange and also automated market maker. Before that, I spent 15 years in Wall Street.
Awesome. Good morning, Matthew Rozak, Chairman and Co-founder of Block. We build Web3 infrastructure and applications. We built a DeFi platform called Vesper Finance, which provides yield for crypto holders. I also serve as chairman of the Chamber of Digital Commerce, the largest trade association in crypto. So a lot of the advocacy in this space for the last 8 years.
My name is John Wu. I'm president of Ava Labs, the team behind Avalanche, the first layer protocol. A few things that Avalanche is known for is its healthy DeFi ecosystem and the apps that are on it in the DeFi ecosystem, as well as the chain itself has what we call instant finality, where settlement and payment happens literally instantly. And also, I'm very happy to be here because I know some of the participants here because I used to also work on Wall Street before becoming an operator. And so I hopefully can answer some of the questions on top of your minds.
Well, to kind of pick up on that, I guess, as well. So you mentioned you're one of the healthy sides of DeFi, and Mike Novogratz earlier today, he mentioned how DeFi has been the one thing during this winter that has worked as intended. So why don't we kind of start off with kind of separating the concepts of CeFi and DeFi for everybody. What do we mean when we talk about centralized finance versus decentralized finance? You can take that.
So when I say TradFi, I mean banks and large asset managers that everyone's familiar with. When I say CeFi, I really mean the 2.5 or people who create the on-ramps for traditional people to access DeFi. And DeFi is the permissionless protocols where rules of engagement and asset ownership are embedded into the platforms itself, allowing users to actually own and profit from their own data or assets. That's what DeFi is to me.
But what has been the kind of difference, I guess, between the two in the last few months then? Like Mary Catherine, what have you been seeing as the difference between how CeFi has performed and DeFi has performed? Because it really has been a tale of two sides in both halves of this crypto winter.
So CeFi or centralized platforms have completely different infrastructure, completely different operating models. So for example, when you have a crazy trading day or high volume trading day in a TradFi institution, you can feel it on a trading floor. You have people monitoring all the exceptions, you have lots of different systems that have to be working at a different level in concert together, and you have obviously humans ultimately making decisions. CeFi is only one step further from that. It's kind of the same infrastructure, just for digital assets. So elements of it, some intermediaries may be removed. But then in DeFi, for example, on Uniswap, we have a $7 billion trading day in the Uniswap protocol or a $500 million trading day. There's no difference. And it also has no impact on Uniswap Labs. So the protocols operate autonomously. They are self-executing smart contracts. And so some of the market activity or the volatility doesn't necessarily affect the infrastructure. And what we've seen in the past few months is that infrastructure has been robust in many cases, not all cases. It means you have to have really robust smart contracts. That means auditing. That means the best developers. That means battle testing them before you deploy them. I don't want to pretend that that all teams necessarily employ those same practices just because they're DeFi. And the second element that I think is really critical in DeFi, that's part of why some things like Uniswap or some of the lending protocols have performed really well over the past few months, is that the critical decisions, whether that's adding new fee tiers or setting rates, are determined by the token holders or decentralized participants in that ecosystem. And so you're not dependent on human decisions. So that fundamental difference in the infrastructure, in the way that, in the operating model is part of why we've seen some of these DeFi protocols perform very differently than CeFi, which ultimately are managing balance sheets and managing risk.
Yeah.
And so some of the failures and the problems we've seen, as I think this audience is probably very aware, were a matter of risk management and failed risk management. Whereas in contrast in DeFi, we've seen new technology models stand up and perform.
Okay, but then also within DeFi, some of those new technology models have not stood up and performed, Terra and Luna being the key cases in point there. Matt, why don't you tell us a bit about...
Go ahead. I think that in part that was also a matter of risk and risk management, not necessarily the technologies. I think it's important, not all DeFi protocols are designed in a way that may perform in a downturn, right? And so it's critical that people do their own diligence to understand what risk they're really taking.
Sure, but with the mechanics of UST and Luna, that was an element of bad engineering, right? That is surely the given at this point.
And I usually like to say it's tale of two cities, right? But I think the last 6 months in DeFi has been the good, the bad, and the ugly. And just kind of going in reverse order, the ugly was Luna, right? And this is a dynamic that lots of DeFi builders are trying to figure out, which is what are the incentives and ways to attract liquidity to their protocol. And it was a failed experiment, massive failure, and especially in a down market. So these things get pressure tested every now and then. Right now, DeFi is about 80 billion in market value. These chains will be securing tens of trillions of dollars of value. And so this is, on one hand, a lot of people lost money with Luna. It was a bad crypto economic and bad model that was pressure tested and failed. That's important, that failure is important in the totality of DeFi to be successful. 10 years from now, we'll look at it as kind of rounding error in a way, but it's still today, it's profound, it hits hard, and it kind of shakes the industry. So that was definitely the ugly, which then started to play into the bad, which is what we were talking about on the TradeFi centralized finance piece, which valuations went down, balance sheets got tested, and we see now bad risk management in CeFi, which is very different than decentralized finance. So these are basically trading desks that will lend you an LTV of X and standard dynamics in the zip code. The assets people had were extremely volatile, and so when prices dipped, margins and loans were called, and the emperor had no clothes. And so then you kind of look at, so that was ugly, that was bad, and now the good. And so the good is DeFi has worked as programmed in the best way possible, meaning even today on some of these liquidations with Three Arrows and others, they are executing their liquidations on DeFi because there's no lawyer, there's no credit committee, there's no bankruptcy judge, it's code. And so it's worked as engineered extremely well on the DeFi side. And so I just want to make sure that these three pots were kind of defined in a way, because we're in the front end of a massive, kind of step change in finance on how people leverage, get yield, and participate in these DeFi networks. And it's a really important moment in time for us where, as builders, this is like a pressure testing moment. And from a DeFi standpoint, I'm extremely proud of how certain DeFi protocols have performed in this market because they got pressure tested. This is what we want to see.
So I noticed you said the engineering failed in the Terra Luna situation.
Well, yeah, it did as it meant to, actually. You're right.
I don't know if the engineering failed. I think it goes back to the risk management, and so the first phase of DeFi, call it DeFi 1.0, what we really saw was it was a great spark from entrepreneurs, engineers, and coders. And what we've gotten is good. We have good primitives, we have a structure, and the actual DeFi protocols actually worked and didn't have halt withdrawals or anything. But a lot of DeFi people, the entrepreneurs, need to understand financial systems better, and therefore how risk management should be done and how things can be set up. The biggest problems with a lot of lending and borrowing type of applications is you are using crypto assets and over collateralizing, which is good in one sense but bad in other, in order to lend and borrow. So what happens is it becomes very reflexive. So you're not, if you want to grow DeFi for 2.0 and to get it really big, you have to have more traditional people come over to use it. And that means you can't be whales existing in DeFi, loaning or collateralizing your assets in an over collateralized fashion. So to do that, you actually need better on-chain identity while preserving privacy so that you can do credit scores, et cetera. And you also need to tokenize real-world assets. And that's going to be a movement into DeFi 2.0, I call it, or phase 2. And you're going to really have teams, just like a venture capitalist uses, where there is like engineering and a visionary with domain expertise for financial services people to structure the economic mechanism much better. It's not just necessarily the code failing. The code actually worked.
But how have you seen that institutional interest grow, dissipate, mature over the period of these last few months where it has been rocky? Because I assume probably like prior to Bitcoin hitting its peak in November, DeFi interest from institutionals were like sky high. And now probably there's a little bit of cooling off.
So from the institutional side, it's actually continued to grow. This has had zero effect. You see it every single day. You see, JP Morgan coins still working out there. The Monetary Authority of Singapore, DBS, and JP Morgan are working on Project Guardian, which is a wholesale lending tokenization in order to create a DeFi for institutional product. Citibank just assigned a custodian. SocGen is doing things with MakerDAO. The volume of calls I get as an operator from institutions and financial services are all increasing. And that's just from the institutional side. From the individual side, again, marrying great domain expertise with coders, the people who work for people in this room are all still making the shift and having great ideas on how to create new primitives that can advance the entire ecosystem. So I think it's very important that everyone here pays attention to DeFi, especially DeFi 2.0, because otherwise you'll get left behind because it's still moving.
And I agree with that. I think there's some people that have their heads in the sand now to say, hey, everything going on in crypto is bad, and and kind of kick the can down the road. I agree with John. The undercurrent of market participants, institutional market participants coming into DeFi is very strong. And what's happening now in DeFi is that there's a fork in the road. As builders, as if you're running a protocol or an application, there's two worlds developing. One is the decentralized finance, permissionless version of this as we know it today. And then there's a photocopy version, so the same smart contracts, the same logic getting ported over, but now they're permissioned. So everybody's KYC'd, everybody's AML'd, it's JP Morgan knowing Goldman Sachs, knowing Citibank are on this chain and they're lending. These primitives are getting exercised and developed and thought through now. And so now we have this $80 billion market going to several trillion, and we have this centralized permission one. And it's going to be interesting to see how these two over time converge or kind of interoperate with each other. So that's kind of what's happening behind the scenes in DeFi on the institutional front. They're not comfortable necessarily putting money on the permissionless, but they are very anxious to figure out this permission version.
Because, I mean, Mary Catherine, my idea for this is, would you call that DeFi, basically? Does institutions getting involved in DeFi actually make it not decentralized anymore?
Not necessarily. So I do think part of the benefit of DeFi and the permissionless system, so for example, and I'll keep using Uniswap as an example, is that when you can have so many different participants, you can have, in the case of an exchange, like greater market depth than even the centralized exchanges. So the challenge in making the transition that was just described is how do you then not fragment liquidity? So the photocopied systems that have been developed so far haven't gotten massive adoption because they've had too few participants, or they have, in the case of a lending protocol, lots of lending demand, lending supply, very little borrowing demand. And the borrowing demand in many of the DeFi protocols comes from people who frankly kind of need the permissionless context in order to participate. And so I do agree that the institutional interest, actually, we've seen it be even stronger in the past few months, I think in part because there's less distraction from trading strategies, market volatility. We're sort of reaching a little bit of a stability point right now in July. And so we've seen a lot of interest in how can we bridge the benefits of DeFi protocols and the technology, but also the needs that John described, which is like on-chain identity, knowing who your counterparty is. So I don't think that just because you have more identity information doesn't mean something's not decentralized. That doesn't necessarily change the way that the technology operates or the way that like critical decisions and evolutions in the technology are made. So for example, I think that there's an opportunity with DeFi to have even better identity management. There's more transparency, there's more information that you instantly have. And so I think part of what's unfortunate about some of the regulatory dialogue right now is that rather than talking about how this is an opportunity for better investor protection, for better disclosure, for better KYC and AML, we instead are just focused on some of what's already existed. And it's really an opportunity, I think, to have a much better series of regulatory solutions.
Yeah, and kind of moving on to regulation as well, we've seen a few things popping up across the globe as this crisis has unfolded, particularly focusing on things like stablecoins, which are probably easier for regulators to understand because they operate slightly more similar to fiat currency and banking institutions. DeFi has largely been left out of that. How do you think that that is going to affect DeFi's chances in coming out of this crypto winter a stronger group when regulators are largely ignoring it for the most part at this point?
Well, I don't think DeFi is actually left out of it because you just mentioned stablecoins, and I think most of the panelists before said stablecoins are one of the most urgent areas that they want to regulate. And stablecoins are actually the lubricant that makes DeFi work. So it is not left out of it from that perspective. Also, I think what's important is we need to figure out global standards. OFAC is the one thing that is global, but for accreditation and other things, it's different rules, different geographies. And how do you have a truly global system if every region, every country has different rules? That's something we still have to figure out.
Are you hearing anything from regulators on your guys' side about how they're seeing DeFi protocols in future regulation?
Yeah, regulating DeFi is hard. I mean, it's putting yourself in the shoes of the regulator. It's hard to figure out how to put this into a box, right? And you look at the regulatory framework here in the U.S. Bitcoin's got clarity. Ethereum, maybe some adjacent clarity, but there's not that much clarity in the space here in the United States. A lot of the enforcement actions have kind of created some more confusion than clarity, and so I think with the executive order that came out of the White House and basically promoting responsible innovation and figuring this stuff out versus being very prescriptive to say CFTC, SEC, Treasury, do these things. It was more like study this technology, it's important, it's going to change the fabric of finance, and get on this. And that was an important piece in my mind because being prescriptive is, I think, hard and detrimental to innovation. So it's a process, and we're still in the super early days. Well, we're in a crypto winter. This market is here to stay, and it's going to grow like crazy. And so I think responsible innovation with a way to let these rails, these railroads, these protocols grow, and then decide how to figure out how to regulate it is a better approach. But it's hard to do that today with the agendas they have, their to-do list generally, and then they see this nascent industry that's kind of nipping at the heels of broader finance. it kind of is the last priority for them. It keeps going up in priority every single month and day since Bitcoin started, but it's still tough for them to put into a rubric that is familiar.
I would agree. It's a totally new paradigm for financial services regulation. So if you think about how we regulate transmission of information or the internet, we don't regulate SMTP, the email protocol. We regulate the applications on top of it that create risk, that are where somebody's going to get phished or scammed. And so I think it makes sense for us to move to a paradigm where that's similar in the case of DeFi, where you're not regulating underlying protocols or open source code, but you are regulating and thinking about the right investor protections at the interface layers, the application layer. But I think that regulators are, and that's a whole mindset shift for a financial services regulator who's used to finding who is the central intermediary that I can hold accountable and what rules do I impose on them, how do I force them to give me information. I do think regulators are educating themselves on it, though. I know in the past 2 months, we had 2 CFTC commissioners reach out to us and come by our office just to learn about how decentralized market structure can create more stable liquidity and ultimately fare better in times like this. So I'm optimistic. I think it will take time because it's so different, but I am optimistic that we'll come to a pretty good outcome.
And so what happens in markets between like holding our breath, waiting for clarity, is markets start to self-regulate a little bit, just to say, hey, these are best practices, these are do's and don'ts. Even when you deposit money into a DeFi primitive, there should be stratification of risk, whether that's aggressive because it's got a high yield, or it's conservative because it goes through AVA and Uniswap and Compound, and these are all wall clock tested protocols, have liquidity, et cetera, so they're more conservative. So I think striping some of these protocols in terms of a risk spectrum, which wouldn't come from a regulator, would come from the industry, I think would be a mindful kind of outcome on some of these standards. Vesper, our DeFi protocol, has been audited independently 50 times. Our next competitor was audited 3 or 4 times. So audits, clarity on risk, I think all these things that we could do as an industry can improve the dialogue once regulators get their arms around this.
Yeah, I mean, you mentioned self-regulation there, and if we think back to what Novogratz was talking about this morning, he said self-regulation was the thing that was meant to be the thing keeping the industry in check for the last few months, and actually has so far, in some cases, not been the thing that has held things up, and that's why we've seen these massive increases in counterparty risk. How do you think that self-regulation conversation is going? Because that's really been the go-to for industry so far.
Definitely improving, and like Mike said earlier, there are certain chains already that disclose, founders and C-level people who sell. So it is definitely moving towards that, but we need more guidance.
And then kind of finally, as well as a forecast, like how do you think DeFi is going to look in the next year? Are we going to see more pain in the markets to come, or is there going to be kind of a mellowing out? I know, Mary Catherine, you mentioned a sort of stability period at this point.
Well, it's not like it was in May, so it's certainly different, I'm optimistic that we'll see a lot of exciting innovation. So I don't know if we'll see growth in retail users, but I do think that like institutional partnerships are going to pick up. I think that we'll see more examples of creative approaches to identity and KYC on chain that aren't just permission pools. I think we'll see cool ways to flag risk at the user level. So because there's so much information on chain, you could start to, players like Uniswap could flag red, yellow, green, the level of risk in the tokens. I think we'll see the emergence of identity solutions, risk management solutions, and a bunch of exciting stuff that will make the whole ecosystem feel safer. So hopefully, in a year from now, it looks pretty different and it's more evident how this is the future of finance.
And Matt, with the merge also being on the horizon, how are you seeing that play into your future forecasts for DeFi?
I mean, we're kind of 2 years into the DeFi odyssey as we sit here from the DeFi summer 24 months ago, and I see a bright future for DeFi. We're in this kind of lull here, but a lot of the assumptions for the utility of DeFi have been proven out 100x. Where we go from here with the merge, everything else, I think that will catalyze. I think a lot of people are staking on ETH, getting a yield. It's a DeFi primitive of sorts, and I think that will continue to create a flywheel of interest and adoption. If I'm an institution, what's my baby step today? I'm buying Ethereum or Avalanche or some kind of layer 1 tech, and I'm staking it, and I'm actually earning a yield. So you are making money on your money. That's a good first baby step in this space. After that, then you're like, okay, maybe I should optimize this yield, or maybe I should take a loan out against my principal. And so that's kind of the staircase stepping of a lot of people that come into DeFi. But Ethereum and the merge and the crypto economics around that, the incentives, I think are a good catalyst for institutions to baby step their way into crypto.
Anything to add on that?
Yeah, absolutely. I mean, from January to call it May, if you look at the large basket of cryptocurrencies, it was 75.75 correlation to the S&P. And come May, it dropped because of idiosyncratic stuff to like less than 50, 0.45. We have, I think, troughed the idiosyncratic stuff. Maybe there's a few more things left, and we're going to go back to 0.75-ish to aggressive growth assets like SaaS companies or internet companies. And then where the macro goes, I don't think anyone in this room can actually predict that.
Well, thanks for joining me on stage. The day is just getting started. We have a conversation with Sam Bankman-Fried coming up and a session on crypto mining's climate impact. We'll be cutting to a short break now so you guys can network, have a stretch of your legs, get a drink, but we'll be back in here at 10:55 sharp. Thanks.
Thank you.
Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please welcome to the stage Gryphon Digital Mining Chair of the Board of Directors, Brittany Kaiser, and Ripple co-founder and executive chairman Chris Larson with Bloomberg's Katie Greifeld.
Hello. So I'm here. Brittany and Chris are not, but I understand they're right over there, so that's good to know. So I'm Katie Greifeld. I'm a journalist for Bloomberg News. I'm also an anchor for Bloomberg Television. Brittany Kaiser, she is the chairman of Gryphon Digital Mining. And Chris Larson, he's the Ripple co-founder and executive chairman. He's also a backer of Change the Code, Not the Climate. So thank you both so much for joining us. I'm still deciding where I want to look, but I can see you both right there. I guess let's start with some scene-setting questions. And I want to start with you, Chris, because we all know what Ripple is, but tell us about your avenue into sort of the environmental side of crypto and Bitcoin.
Yeah, well, again, thanks for having us. I actually spend most of my time now in climate change projects. That's my main job these days. So we just can't ignore what's going on in our own industry in crypto, and in particular with Bitcoin mining. It's a problem. The climate we're in crisis, and we've got to address it. And again, we hope we can get it to neutral, which is where most of the industry is today, carbon neutral, but maybe even get it to massively carbon negative. I think there's an opportunity that only Bitcoin has, and that's kind of exciting, but that will take a long time to get there, but that's the hope.
And Brittany, when I go on Gryphon's website, I see ESG-driven mining. And to a pessimist, that might sound like an oxymoron, but I'm hoping you can just walk us through it. What is sort of the driving force behind Gryphon?
Absolutely. When we started Gryphon in late 2020, we specifically were seeking to create the first ESG-focused carbon negative miner. So our thought was that most people in the industry are still plugging into mixed grids or using fossil fuels, even if it's not the majority of their energy source. So what we wanted to do is focus on using 100% renewable sources and also nuclear energy to create Bitcoin. And then on top of that, investing into carbon sequestration, carbon removal, reforestation projects, instead of just traditional offset, so that we are making sure we're a positive impact for the industry and for the environment as well.
And so when I was asked to do this panel, I was excited because on paper, Brittany and Chris, they're on two different sides of sort of the ideological spectrum here. So I want to ruffle some feathers. So Chris, I mean, in your ideal world, would you put Brittany out of business?
Well, no, absolutely not. First of all, Brittany's a hero, right? I mean, she's doing the right thing. The problem is the code that is embedded in proof of work in Bitcoin doesn't incent the kind of behavior that Brittany is leading here. So it's too easy for other people to say, hey, look, it's just cheaper to find waste coal plants in Pennsylvania, which is happening, which is shocking. Or when fossil fuel prices, when that demand finally eases and the prices dip below renewables, look, the miners will go there. So the problem is in the code. We can't rely on the goodness of folks like Brittany, who are true leaders. But unfortunately, the code is what sets the incentive. We've got to change the incentive.
So what does changing the code look like? What actually in practice would that look like?
Yeah, I mean, it's not going to be easy. It's going to take years. But whether that's a soft fork with the community going along with this necessary change, knowing there's a crisis here, or it's a hard fork that is driven by kind of a younger generation of people that are going to be more dialed into the problem. But what we've got to do, and so this is the thing I think that's very different from Ethereum. Obviously, it's switching the proof of stake. I actually believe it would be a lost opportunity if Bitcoin changed to proof of stake, because it does have what Brittany represents, this incredibly entrepreneurial, powerful mining industry, which is not the problem, right? The problem is they're being incented to do the wrong thing, which is burn as much energy as possible. What if you could incent them with a change in the code that says, hey, work in proof of work is not burning energy for all these guesses, but rather maybe creating renewable energy you're pushing into the grid. And based on how many joules of renewable energy you make, you get a higher chance of getting that reward or proposing the new ledger. Or maybe it was based on direct air capture. The more molecules of CO2 you captured, the more odds you're going to get that reward or be able to propose the new state of the ledger. That would now completely flip the script.
So we're going to get to proof of stake, but Brittany, I want to get your thoughts on that. When it comes to changing the code, whether that's possible and whether it should be possible, because a maximalist would tell you that probably shouldn't alter the code at all. Where do you fall on that?
So for me, as someone that traditionally comes from the data protection and privacy standpoint, I really think that the importance of proof of work is obvious. It's basically impossible to hack or manipulate a system where billions of dollars of ASIC computers are decentralized around the world. So therefore, the importance of proof of work is there, and it's obvious, and it's one of the most important technologies that we have today. Now, changing the code is something that happens every now and then. There was an upgrade to the network made last year. It takes the majority of Bitcoin miners around the world signaling that they do want to do that upgrade. Last year was called Taproot. So if there was a proposal out there to upgrade the network and change the code, it would take convincing most miners around the world to decide to go for that. So as Chris said, it's not simple and it's not easy. Now, for me, I prefer other types of incentive changes. I do a lot of legislative and regulatory work in the United States. I've been working in the state of Wyoming for the past 4.5 years, helping write and pass 23 different laws on digital assets. And we're starting to see now other states around the US that are passing crypto laws, and we're seeing mining incentives or mining disincentives that are being passed. For instance, in the state of Kentucky, we now have mining incentives, but it has nothing to do with renewable mining, just mining in general. And so I think that is going to drive a lot of fossil fuel burning companies that are mining Bitcoin to Kentucky, whereas you see the opposite in the state of New York. They have completely banned any non-100% renewable Bitcoin mining. Now, I have large operations in the state of New York, and they are not affected by that because we're using 100% hydroelectric energy. A lot of people ask me if I was involved with that law because it basically takes the competition out of the state. I was absolutely not involved with it. I don't really believe in those kind of draconian legislative initiatives because I don't think that Bitcoin mining is really a competition. But what it basically says is Bitcoin mining is now the only industry where you're banned unless you're 100% renewable. I would love to see that for big tech, for construction and infrastructure, for other industries, if New York really cares about incentivizing renewables, because for sure Bitcoin mining is not the biggest industry in the state of New York. Right. I really think we should find a happy medium and find a way for there to be incentives, whether that be tax incentives or something else, to make sure that miners have a reason to choose renewable, if right now renewable is not cheaper than using a mixed grid or straight fossil fuels.
And we're going to get to renewables, but I want to harp on the code and proof of stake for a little bit longer because we flashed that Twitter poll a few minutes ago. I would love to bring it back up. We harnessed the power of our Twitter audience, asked them the question, would Bitcoin ever change from proof of work to proof of stake? Everyone said no, pretty much. I know what you guys are going to say, but I still want to ask you the question of why isn't there ever going to be a world, or why, in your view, won't there ever be a world where Bitcoin does go to proof of stake? Because if you think about sort of the sustainability of Bitcoin mining, this is probably overly simplistic, but it seems like proof of stake would be a simple solution. Chris, would love to hear your thoughts first.
Well, there's problems with proof of stake, certainly. So it's trade-offs, right? But I think, again, Bitcoin moving to proof of stake, it'd be a lost opportunity because it's the only one now, and especially with Ethereum changing, that will have this incredible industry. You have to give it to the mining industry. It moved practically the entire business from China to the US in a matter of months. It raised billions of dollars, incredibly entrepreneurial people. So that's an asset. And if you move the proof of stake, it all goes away. So why wouldn't the miners correctly oppose that? They should. A better solution would be moving to something like proof of useful work. And, there's a lot of teams that are working on just that thing. The issue here, the problem to solve is in Bitcoin proof of work today, you don't have to prove the work. The result proves you did the work, that you guessed the correct number. What you need to do when you're talking about work based on atoms or joules of renewable energy, you have to be able to measure that work as it was done. So how do you do that in a secure, censorship-resistant way? That is the challenge. But there are teams working on that. And I'd say to the Bitcoin community, look, if you can get a system that is equally secure, equally censorship-resistant, but it's based on this powerful notion of miners now solving climate, I mean, you'd have to admit, wouldn't that be the greatest demand generator for the Bitcoin, asset? Everybody would want to own it. And the more the price went up, the more you're solving climate. And that's the reverse of what you have today. Bitcoin community should see the biggest risk to Bitcoin is climate is getting worse. We see it in the news every day. And Bitcoin is contributing to that. And this newer generation, this future generation that's not even born yet, how are they not going to reject that? And Bitcoin will be isolated, especially as Ethereum changes. So we need to be working on that and encouraging that new, kind of spirit of innovation. Frankly, I just don't get how the Bitcoin computer, the people that create, we're going to create the future, have turned into these extreme reactionaries that don't want to change anything. Come on, that is not what, Silicon Valley, the technology community was built on. It was built on a can-do spirit. Let's get working.
And to Chris's point on security, Brittany, I know that you have thoughts on that particular topic.
Yeah, absolutely. Well, in proof of stake, it's possible to spoof that you have stake, and therefore it makes the network more vulnerable. I don't believe that getting rid of proof of work is going to solve anything, which is why I think it's so important that we consider different proposals on the best way forward. And what Chris said is incredibly important, which is the mining community needs to start finding ways to prove that we are using renewables or nuclear, so green energy. In order to prove that, it's actually very technically complex. Over the past year, I've been working with a group called Energy Web. I think a lot of people have heard of them now. They were the founders of the Crypto Climate Accord, which allowed the entire crypto industry, not just Bitcoin mining, to sign on to certain decarbonization promises, both by 2030 and by 2040. And they have really organized a diplomatic group for us to engage in international climate change diplomacy, and that's been incredible. But on the technical level, we've been working with both Energy Web, Zero Labs, Protocol Labs on different technical ways to prove that where your mining machines are plugged in, that it's using a particular energy mix and an energy source. And to be able to verify that, and therefore be able to prove that you are creating green digital assets. Now, there's a huge amount of steps to that. We don't have enough time today for me to go through everything that takes.
We've got 12 minutes.
But in the end, what it actually means is that you're able to trace the energy source through to the mining, through to the creation of the green digital asset or the green Bitcoins. And therefore that opens up those Bitcoins to ESG focused funds. It means organizations that are only interested in purchasing Bitcoins that have been created through green energy, that they can do that. And it also allows the industry to become more responsible, because now we've created an incentive structure where some of the biggest asset managers in the world that have a mandate to only be investing in ESG friendly assets, that they can now include the Bitcoins created by certain companies or by certain mining pools. And that will really change everything. So really the development of these technologies has been our focus over the past year.
And Brittany, let's go back to renewables and sort of the power sources that you've been talking about, because I'd love to get specific and sort of name names here. I mean, what other uses of power are you looking into?
So right now we're mainly using hydroelectric and nuclear just because of its reliability. Now we're also looking into large scale opportunities in solar and wind. But when you get to solar and wind, if you're going to solve for the latency, you're either going to end up using batteries, which normally end up being lithium, or you're going to have a type of green hydrogen or even a fossil fuel solution that is going to make up for when the sun isn't shining, when the wind isn't blowing. And so I think it's really important for us to recognize that if you are a company that relies on energy running 24/7, that solar and wind still have to have some kind of supplement. And we all know that lithium isn't good for the environment either. So retiring lithium batteries is not really the best answer. Neither is supplementing with fossil fuels or into a mixed grid. But I think a lot of companies that are investing in large-scale solar and wind opportunities do see that as a much greener option than where their machines might be currently. And so I'm not knocking it whatsoever, but I do think that nuclear and hydro are really two of the best options for the industry right now. And that's why we're using so much hydro and nuclear energy in our Bitcoin production.
So we've got less than 10 minutes left. I'm still trying to make you guys fight here. Chris, does renewable energy go far enough?
No, and so I agree with half of what Brittany just said.
Okay.
Right, is let's come up with a proof of useful work that can measure work as defined by how much renewable energy you created, right? But again, if you could do that, then why not just make the whole system based on you created renewables, you didn't use renewables, right? The other thing, by the way, I just don't agree with at all is you can't have a green Bitcoin and a dirty Bitcoin, right? They have to be fungible. Those are two different coins. So you can't have a market like that. That would be a hard fork. But let's get back to the renewable thing. The reason we got into this whole campaign in the first place is because of that outrageous greenwashing report that Jack Dorsey and others put out about a year and a half ago, saying literally, quote unquote, that Bitcoin mining is the key to a renewable future. Like nobody in climate believes that. It's just utter hogwash, but it led to, I think, a lot of bad behavior, right? Justifying that somehow was a good thing. Look, we need renewables for everything else, right? And that was true a year and a half ago. It's so starkly true today. We're not only in a climate crisis, we're in an energy crisis, right? You have China today saying, hey, we may have to start importing coal again because we're lacking energy. Bitcoin mining is not creating new renewables, it's getting in the way, right? And again, what's the purpose of these consensus mechanisms? It's to validate state in a secure, censorship-resistant way. That's the objective. And now make that as efficient as possible. This notion, again, that somehow the use of energy in Bitcoin is the feature, not a bug. It's just backwards. So we've got to fight that notion, and we've got to work on things that get to neutral. And again, I agree, proof of stake, I think, is the wrong approach for Bitcoin. But proof of useful work, as Brittany was just talking about, if you can validate how much renewable energy you created as a miner, but instead of using it for guesses, push it to the grid and then just give those miners the number of guesses equal to the number of joules of renewable energy they created. Again, if you can validate that work, that's the key here, then do it that way, because now suddenly you're massively carbon negative, and it'd be the only coin that was like that. Bitcoin is the only coin. I know people have read Ministry of the Future, right? They talk about this mythical, carbon coin. Only Bitcoin has the shot to do that, but only if the people that are in the industry get out of their extreme reactionary posture of no, and get back to no. Technology is about change, is about being proactive and get busy. Like, I can't believe there's not, with billions of dollars at stake, trillions of dollars, why aren't there 10 projects being backed by the Bitcoin community to find a new proof of useful work? Why aren't they working on that right now? So they've got to get out of this posture. And part of the campaign is to inspire, look, if it's not the people in the industry, a new group of people around the world that are being impacted to get to work, come up with a better system, and make Bitcoin truly the game changer that it could be, but that it isn't today.
Brittany, definitely want to give you a chance to respond.
Of course. So for me, I really think that the way that I see the Bitcoin mining industry, and indeed plenty of other digital assets that are created out of the crypto industry, is that this is an incredible opportunity to fund the large-scale development of green energy resources. Even now, tons of the projects that I either work with or have been in communication with around the world, those renewable energy sites have only been able to develop and grow because they have been funded by Bitcoin mining or another type of crypto mining or even staking operations. So it's possible that if we actually were to start measuring and over the next many years really be able to drive money into renewable energy development and nuclear energy development, so that although Bitcoin mining is taking a certain amount of energy, it's actually funding exponentially more green energy than it is taking. And just as Chris said, pushing that back to the grid is so incredibly important. At so many of these renewable energy sites where both myself and other and other mining companies are working, the excess energy is being sold back to the grid. And the only reason why those sites are being scaled up is specifically because of the income from the mining companies. And so I think that is a way that a lot of people are not really looking at as an incredible opportunity where Bitcoin miners can become the greatest financial partner with countries in reaching their climate goals, as opposed to becoming an obstacle or a hindrance. I'm not saying that is already a trend that is happening all around the world in terms of vast majority of situations. I'm saying if we decide to design it that way, if we design for it and we plan for it, then it's very possible for that to be what we see in the future.
And so,
again,
sorry, go ahead, Chris, please.
Yeah, I was just going to say the key to what Brittany's saying, though, you need the code change, right? You need the code change to flip it from an incentive to use to an incentive to create. Because let's keep in mind, if you look at solar prices today, they're not going down anymore, right? They're going up, right? Polysilicon prices now $40 a kilogram. That's the highest they've been in 10 years. So again, there is no demand problem for renewable energy. It's a supply problem. Everybody's trying to build on renewables. Europe, I mean, look what's going on with Ukraine. They're in a mad dash to get energy from anywhere. Bitcoin mining as it's structured today is just getting in the way. But if you had a code change where it flipped the script, it could actually be a huge part of the solution, but you've got to change the code.
Well, to that point, we have less than 6 minutes left, and it'd be remiss if I didn't mention the moment that we're in for the crypto industry. I don't know if you guys have heard, but there's been a massive drawdown. And when it comes to the incentive for that code change, and I'll ask a version of this to you both, Chris, do you feel that that has just fallen off the priority list, that the issues that are facing crypto right now are so great that is this even on people's radar right now that we should change the code of Bitcoin to make it more sustainable?
Well, I would argue it's more so than ever. Most of the industry's been humbled, and that's a good thing, right? It's a normal tech cycle that you go through, but it's a moment to reflect on what's working and what's not working. And you'd have to say that Bitcoin mining in a world that has an energy crisis and a climate crisis, it's not contributing to the solution. It's part of the problem. So if you're reevaluating kind of where you are, how do we make this technology truly valuable to the world? Change the code and make it so. It's so in our grasp. But the problem, you're right, it's come down a little bit, maybe from 140 trillion watt hours. I think today you're at about 80 terawatt hours. So that's better. But the history of Bitcoin is these price changes, they'll start going up. It's going up today. It's been going up nicely all week. It will recover, and you're back to the same problem. So now's the time. Crashes are the time to be rethinking things and to be relaunching new models. That's the history of technology. That's what we should be doing.
And Brittany, let's bring that question specifically to the miners, because obviously the mining industry has been under a lot of pain. And when you think about, the cost that it would take for some of these miners to switch to more renewable sources of energy, I mean, do you feel that momentum has been lost at this moment? Same question. I mean, has it just fallen off the priority list?
It might have for some other companies that are struggling to stay afloat. I'm lucky that at Gryphon Digital Mining, we have an incredible team that made sure that we had a business model where we would always be in the green and that we were not wasting any time or money or energy. But there are so many people in the industry that are now struggling to make ends meet and wondering whether they're going to have to sell or shutter their doors. And so in that situation, when renewable energy sites are actually raising prices these days, a lot of miners in the industry that do not have an ESG mandate, I'm sure, are just going to be choosing the cheapest options possible, whether or not that's using fossil fuels or renewables. It's just going to depend where their operations are. And of course, Gryphon's lucky that we decided to start our company on green energy. If you started your company using any type of energy, the cost that it actually takes to move all of your machines to another site is probably not going to be a cost that you're going to choose to incur at this time.
Well, to that point, I mean, do you think that some miners will be forced to make that choice to move? I mean, I think about what's going on in Texas with Bitcoin miners being forced to shut off their machines, for example.
Yeah, I mean, I think that there will be plenty of mining companies that actually have to shut down, and they'll be selling their machines and their energy contracts to other companies. That's definitely going to happen. It happens in every low cycle and every bear market. So we're definitely going to see that. And of course, we're going to see less companies making those good, positively impactful decisions, because usually that requires extra investment on behalf of the company to make sure that they have an ESG budget, to make sure that no matter what those renewable energy prices are, if they have the capacity for those machines, that they're willing to pay it. So it is a dedication on behalf of the company and the investors in every company that if you are ESG focused and renewable focused, that it probably costs more to do that. So you have to have a business model that can actually sustain this type of waxing and waning of the industry.
So we've got a bizarre amount of time left, only 30 seconds. I don't think I'm going to ask a question and try to force you to talk quickly, but I did just want to say thank you. This has been a really great panel. Have really enjoyed the audience too. Great to actually see physical bodies. But Brittany and Chris, thank you both so much for your time. This has been really great, and great to hear your perspective on this very strange moment in crypto. So
thank you so much.
Thank you all.
Thank you so much for having us.
Please welcome to the stage FTX founder and CEO Sam Bankman-Fried with Bloomberg's Matt Levine.
Sam Bankman-Fried probably needs no introduction. He probably bought your company last month. So I think we'll probably just get started. Sam, thanks for being here.
Well, thanks for doing it.
So last time we talked was in April, and we made a little news. I was asking you to explain yield farming, and you did it in this way that sort of described a box that tokens came out of, and people put money into the box. And there was a sort of self-sustaining flywheel where people put more money into the box, the tokens were worth more, and they went up. And I used the Ponzi word in reaction to that. And you didn't exactly endorse that, but definitely the crypto market went down shortly after that conversation. And I wanted to revisit that a little bit. Like, you know, at the time, I think we were abstracting away from the usefulness of crypto projects and just sort of talking about tokenomics. But given that the token market kind of collapsed, like, what lessons should we draw about the usefulness? Like, how much of crypto at that time was kind of people investing because line went up rather than because of like usefulness of projects?
Yeah, and that's certainly something. Some of it for the whole space, and more strongly than that, it was some of it for many spaces, right? Like, I mean, NASDAQ's down, what, like 40% or something like that since the peak. And so some of this is herd behavior. Some of it is herd behavior triggered by monetary policy, right? Like, to the extent that you know the world believed that there was going to be easy money forever, and you know all numbers would keep going up except for the value of the dollar. You know, people kept investing, and then there's a strong signal change, and all of a sudden people felt like numbers could go down because maybe money was going to flow out of this system instead of into it, and sort of, you know, everything came down in price. And so some of this is not a crypto-specific phenomenon. Some of this is like what investing looked like at sort of peak mania. But, you know, I think putting that aside, you know, I think that Bitcoin's price roughly reflects that dynamic of like inflows and outflows into the monetary ecosystem. I think that like certainly the asset, you know, price decline was a strong sign that in crypto and frankly in a lot of fintech, like things were way too light on use cases, and that there was a lot of hand waving going on both on use cases and on sort of financial modeling that was suspect. But I think beyond those two, you can look at things that didn't just fall 60% in this crash, but fell 99% in the fall, and that's when I think you start to look at things that were sort of worse than just like, yeah, there is a change in monetary policy, a change in investor sentiment. Like those are the types of things where there was probably artificial mechanisms sort of that were, you know, creating these flywheels, driving it up with nothing fundamental backing it. and then the flywheel starts to falter, and the whole thing crashes back down. And obviously, Luna is like, the prototypical example of that. Celsius probably you'd put in a similar bucket, and I think that sort of is a layer of which I think is a lot of the long tail space of crypto, and some selection of what were considered sort of more respected second tier places that were probably worse than just like monetary policy change.
I think that people say a lot about bubbles is that there's a sort of misallocation of capital, and like does that make sense in this space, like to talk about that, and like is capital being like sort of better allocated now after the winter? Yeah, I think it is. And I think it does make sense to talk about that. And I think that like where have the sort of re-ratings been, so to speak, whereas the relative re-ratings been? I think one thing, when you look at the companies in crypto and frankly across the space, I think profitability was sort of a dirty word for a number of years, and it has returned to investor parlance, right? Like last year, if you saw a typical funding round from VCs, like was that valuation related to the profit of the company? Probably not. Like revenue was sort of like there's sort of, without saying so explicitly, everyone just subtly slipped from like, EBITDA or profit or something to just purely revenue as like the driver of value, and like no thought towards like how profit would eventually catch up to that. And I think that there's been a substantial re-rating towards looking for at least likely or at least plausible pathways towards profitability being a core component of an investment thesis in a company, which feels a little strange to say, but I think was something that was kind of missing. And then when you look at tokens, I think that like there's this sort of question of like, if everyone woke up one day and this thing was gone, would anyone miss it, right? Like would anyone be like, oh shit, like someone has to go start this thing now that old copy was gone? And I think that that's been like a fairly strong predictor of which things have survived versus which things have not. And I think that like, obviously, like stable coins have survived, exchanges have survived, blockchains that have some property that is sort of like plausibly superior to other blockchains have survived, including just being like a more consensus, a mechanism with like more built-in consensus from lots of players, and things where like if they went away, you would forget they ever existed, have generally sort of gone away, and people have started to forget that they existed. Can I ask what your sort of interest or knowledge of this is? Like in your day job, I think of you as like running an arbitrage fund and running an exchange that kind of like clips fees from people trading stuff. Like, how important to you in your job is it that things be robust or useful, and how much of it is like, if the number is moving around, then I can make a profit on it?
Locally speaking, it's mostly driven by the latter. Like if you want to say like, what's going to determine how much revenue we make next month, like realistically speaking, like whatever, that's going to be a function of volatility and volume and monetary flows and things like that. And that's the same thing if you look at NASDAQ, right? Like what's going to determine NASDAQ's Q3 earnings this year? People aren't sort of looking at like fundamental, like long-term business models of things. People are saying like, well, I don't know, what's market vol going to be like? I think when you look in a longer-term view, though, I think it is quite important. When I say Jane Street trading, this is something that like some of the more senior people there would say sometimes, and kind of nod along, but not really. Not that I disagree, but it didn't really sink into me, which is, they say, look, sometimes volatile days can be good for profit, but in the long run view, like we like it when markets are healthy and efficient and going up and stable, because that is in the long run what just creates more activity, right? And like, even if you ignore any altruistic things here, right, it's just like that's what long run, and I think there's a similar thing here where like how healthy the ecosystem is in the long run is going to be a very strong predictor of how much we can grow.
So on that note, I want to talk about one big symptom of the crypto winter is like there's been a blow up of a number of platforms that I would sort of loosely call crypto shadow banks, where they're sort of taking in short-term demand money from customers and lending it in weird opaque ways. And you have touched in some form probably all of those. You've been a lender, a borrower, a rescuer. So like the natural segue is like, how much of the rescuing activity is about that very long run view of like it is healthier for the crypto ecosystem that you are levered to for depositors not to be constantly blown up?
That's a real part of it. Like, and maybe to make this like more concrete, like the explicit sort of like working principle we had in a number of these was like, it's okay to do a deal that is moderately bad in bailing out a place. Like the bar was not, this is a good return on investment. The bar is like, this is not that bad of a return on investment, or like we are incinerating a relatively small-ish amount of money in doing this.
And just to tease that out, you're incinerating a small amount of money because like in the long run, you get a large amount of money from the crypto ecosystem being
healthy.
I was going to say healthy, but I almost said popular. Like,
well, I think it's. I think if you want to look at it from just a strictly business case, right? And obviously, if whatever fiscal duty to shareholders to do things that make sense for FTX, you could say, look, it's it being healthy that would cause it to be popular, right? Like ultimately, it's the popularity that would matter, but like that there's a flow through from health there, which is sort of the operative thing. I think there's also just a thing of like, we need to be a good constructive actor in this space. If we're not, it's just like bad on many levels, and ways that we can be. I think we'll sort of like be a diffuse good that like whatever, we don't need to know beforehand exactly how that pays off.
So when I look at the things that you did, some of them are you sort of like, I'm going to shorthand it, you bought BlockFi. You did not buy Voyager, and you incinerated $75 million on Voyager and then said, that's enough, thank you. And then you, I think loosely speaking, incinerated no dollars on Celsius because you were like, that's definitely enough, thank you. Talk about like, talk sort of generally about how you make those decisions and like what, like, like when someone's bad, like what's bad about them? When someone's like blown up but good enough to get an investment, like what were they doing right? Like give me a sense of what's going on there.
Totally, and taking a step back, like when we have to make the first decision, we don't yet know. Right. Sometimes which of those, like if you like called me up tomorrow night and you're like, some very weird things happened and like I'm going to die if you don't wire me $2,000, right? Like I'd be like, okay, fine, let's deal with that, making sure you don't die, and then we can talk about what exactly happened to get us there. And like that.
Except for Celsius.
Right, and maybe I'll tell a little bit about like the first conversation at high level that I had with. Sort of, I'll give a model conversation. This is how I would like the first conversation to go, and it reflected some but not all of our first conversations, which is we get on the phone, and the other party says, hey, thanks for taking the call. We are sort of in trouble. It's a little ambiguous. Here's exactly where we are. Here's where our balance sheet is today. Here's our assets. Here's our liabilities. Here's the uncertainty in it, roughly speaking, ballpark. Here's where it's coming from. Pause for a second, and
I want you to continue, but I want a little bit more, like when they say here are assets, here are liabilities, like which number is bigger?
Right. Yes. Well, I hear you. But
do they use numbers?
That's the first, right? The first test is not even which is bigger. The first test is, do I walk away from that first call feeling moderately confident that I know what the numbers are, whether or not they're good? Do I even know them, right? And like that was like sort of like the test for us to like consider doing like just some emergency thing while we figure out other things. One of the criteria was that we know what the numbers are, whether or not they're good. And some failed that test of like, not just the numbers were bad, but like we literally came away confused. And like we had a second call.
And that's not like valuation. That's
no, that's like we think either they're not being transparent with us or they don't know their own business. Right. But one way or another, they like cannot tell us the number in this account. And like whatever, you mark these into, but we don't even know how many shares of that illiquid thing they have, right? Like it's just like there's nothing there. And of course, no one knew how to mark 3 Arrows capital debt the day after this happened, right? Like that was one of the big.
That's like a number you put on it.
Exactly, right? We would have accepted and this amount of debt with 3 Arrows as part of this, right? So that's step one is like literally, do we know what is going on? And then step two is like, right? We do kind of the obvious thing if we compare the two sides of this ledger, right? And like in the cases where it was most obvious to do something is when they're about equal, right? When the assets and the liabilities are like roughly the same number, and you can imagine someone saying, look, here's the outstanding uncertainties we have. it is plus or minus 20 million, depending on those uncertainties, right? That's the place where it's sort of like most obvious that we should act, because if we don't, they might be slightly underwater, and there are serious questions about like, do they have to take drastic corporate action? But for like a relatively small, sort of like potential incineration of money, we can like resolve that problem and make them able to like continue operating and like carry on and not like cause contagion or customers losing assets or anything like that. So that sort of like is the best case. Well, okay, the best case is that I have tons of extra capital, but then why are they calling us? So okay, of the calls we might get, the best case is when they have about 0 left, right? And they're like, look, we need a buffer here so that we can like definitely pay salaries without dipping into customer funds, like and we're like that makes sense, right? And in those cases, like what we would tend to do is like, okay,
because otherwise they would.
Well, depending on the company, right? Otherwise maybe they would declare bankruptcy, or maybe they would dip into customer, whatever. There's a lot of unpleasant choices there, right? And so in that case, what we'd say is like, okay, first things first, let's just give you a line for something, I don't know, 50 million, whatever. Something that is like definitely bigger than the like plausible downside here. So you definitely have a surplus. And we'll make it junior to customer assets. And it's an amount of money where if we totally misunderstood this, like, it's okay, it's a little sad, but like whatever, shit happens. And then we can talk about what's next.
Junior to customer assets, is that purely being a good citizen for the ecosystem? Because it seems like people can not do that. It seems like one option is to not do that.
Yeah, so the way I see it is like, there are cases where it makes sense to do it, not junior to it, but it doesn't actually solve the fundamental problem here, right? Like, and so like, I think basic the answer is like, yes, like, I don't know, I would feel kind of like, I don't know, we're giving you this senior line, maybe it's useful for you, but this isn't like, I don't feel like that solved the problem that, morally speaking, it hasn't solved their problem, right? Like, I think basically, yeah, like that seems like a shitty way to structure it.
Can you tell me what the problem is? Because like, I mean, there are two sort of broad ways to characterize the problem, which is like run on a bank or balance sheet insolvency.
Totally agree. And that's a good point, which is that there's sort of liquidity versus net asset value or whatever, however you want to think about it. And the junior versus senior thing is primarily a net asset value type thing of like, at the end of the day, will customers get their money back eventually? Whereas a senior line can be useful, and it can be, and so the senior line is something we would absolutely consider if what was going on was they had a mismatch in durations. So one hypothesis about Celsius, which did not turn out to be true, but which was speculated about, was that they were completely, totally fine, except that they'd taken a lot of customer Ethereum and staked it on ETH2, and that it was going to be about a year before they could realize that ETH2, and the customers might try and withdraw before then, right? And in that world, then actually a senior line of Ethereum floated to them equal to that balance would be all they needed, right? And so if it's just a liquidity crunch, then absolutely, like, senior line's totally fine. If it's a net asset value crunch, then it's a lot less clear that a senior, that senior debt is super helpful there. And by the way, like, the different platforms took completely different approaches to how much they gave a shit about the net asset value version of this, right? Some of them gave many shits, some of them did not. And
what do you mean, like?
Well, so like, everyone had to care about liquidity, right? If customers try to withdraw and you can't fill the withdrawal, your business ends. So like, that's clear to people. I'm being a little bit like apocalyptic.
You're saying some people didn't seem worried that their equity was negative.
Yeah, or whatever. There's definitional things going on here, right? You can mark things to whatever, you can sort of, but like, there were a lot of cases where I think like we felt like they had been maybe less than maximally responsible in terms of their actual underlying financial health.
Well, I mean, let me ask a general question. Like one thing that I think is striking about these situations is that like their healthy situation was like 20-to-1 leverage.
Right.
Where like the liabilities are demand deposits from retail customers.
Yep.
And the assets are unsecured loans to fly-by-night hedge funds and like, investments in volatile assets. Like what happened? Like can you like, how does that happen?
Right, okay. So let me describe two different things one could have done. Thing one, lend $1 billion to 3 Arrows Capital and take $1.3 billion of random crap as collateral.
Right.
A second thing one could have done is the first half of that sentence.
Right.
Right? Without the second half.
Right.
And I think that there's a very big difference between those two, right? Like fundamentally, there's risk in both, but with the first one, optimistically, the risk that you're looking at is like maybe something illiquidity market move, quick something, and there's like a 10% haircut on that if you get unlucky. It's sort of like maybe they're so illiquid that's much more than that, but like the second one is like something 100% haircut. Like and so I think that like unsecured was like a relevant piece of what you said. And I think an interesting thing is that like that was a very big determinant of whether a platform blew up, is if they had debt with 3 arrows, was there collateral posted in return? The interesting thing is that like some platforms did, some platforms didn't. That completely changed the situation. But from an outside perspective, what was the incentive mechanism on them to bother asking for the collateral? Like obviously at this point, a lot of people wish they did, but like so much is about the details. I mean, sort of a big detail, but like. Where
did we put all our money?
But it's not like you open up the app and this is obvious, right? It's not like it's sort of like an obvious functional part of the product. Some of these were coin flips about whether they bothered asking harder for collateral or not, and like it's an incredibly important decision. But it's one which like there is no punishment for at all what you did until everything blew apart, and there was no and like if you're thinking about like what could regulation have done here. Right, I think one thing that regulation would really want to do is like ask, is there collateral? Right, like that seems like a really important perspective, that like there should have been some amount of oversight or transparency or like, enforce good risk management on, but there just wasn't. And again, from an outward facing perspective, no one has any idea whether or not you actually got that collateral.
Like, why does 3 arrows need so much unsecured lending? I mean, like, broadly speaking, they're a hedge fund.
Right.
They're financing positions. Why aren't they pledging the positions that they're financing?
Well, at the end of the day, they sort of ultimately did, in that their positions are all gone now. Now,
why are they pledging them to Celsius? But okay.
Right. Well, okay. Maybe they pledged them to Celsius and also to many other people at once.
Sure.
Yeah. But
that's what unsecured loan is.
Right. But maybe another way of saying this is like, how did they lose so much money? Is like fundamentally, it's not that like 3 arrows positions were illiquid. I think they were just like lost money. Like at the end of the day, their net asset value is very negative. And if you get into that position, like nothing, like people lost somehow, right? And I think basic answer is like, I don't know, they were like, probably, I don't know exactly what they're doing, but like that certainly hints at them not being like a sort of like low risk arbitrage firm, and more of a like had giant positions on, and sometimes they did well and other times they didn't type firm. And I think that their like debt was probably rated, treating them as more of an arbitrage firm, and their trading was probably much more punting than market making.
So your hedge fund also borrows from these platforms, or borrowed, I guess. Can you talk about like sort of what's, like, is that sort of like ordinary course financing positions? Is that arbitrages? Are you secured?
It's all, so again, there's some variety here. Generally, they're at least decently secured. Often they're oversecured. And I think basically like part of the underlying thing here is it's hard to get capital into the crypto ecosystem. Like there's giant bottlenecks, regulatory, among other things. And so the spigots that you do see are like people will develop some sort of spigot to connect non-crypto money with crypto money, and then sort of like grow the hell out of it and like try and get as much as they can through that spigot because the other spigots aren't working. And this has been one of the ways that capital got into the crypto ecosystem in the first place. Obviously, there's been a huge outflow of that capital, not surprisingly, over the last couple months.
When you say this, like retail deposits on these shadow banks, which are like
as an
crypto
example,
money,
yeah. But there's others. So there's institutional money in there as well.
Yeah.
It's not all retail.
That institutional money is functionally like, we're going to give money to a platform which is going to lend it out as sort of senior claims on crypto to crypto hedge funds.
That's basically right. Yeah.
Okay. So you're getting all these calls about rescuing. Why are they calling you? Like, why aren't you making the calls? Like, what's the difference between like you run a sort of exchange, what are you doing right?
Collateral. So, well, but seriously, like that is sort of, and this actually interestingly ties into our CFTC application just to some extent.
Yeah, right.
You know, when you look at what is FTX, let's ignore the spot trading for a second and just look at the derivatives piece of this, right? Where, although spot margin, whatever, looks a lot like derivatives in some lenses, the way that a risk engine works effectively is, you know, your cousin Jill wants to, I don't know if you probably don't have a cousin Jill, but pretend you did.
Sure, I can do that.
Yeah, cool. You can substitute the name in your head for you, right? So, you know, Jill has a family office that wants, whatever, to put on a $100,000 Bitcoin futures position, right? Step one is know your customer process, blah, blah, blah. They have an account now. Step one of the like trading piece of this is not them sending an order. Step one is them depositing collateral to the clearinghouse. So, you know, they deposit $30,000 of collateral to the clearinghouse. Clearinghouse recognizes it, says, great, you've got margin, puts on a $100,000 position. From the clearinghouse's perspective, there's no money outside of that $30,000. Like, it's not saying, if Jill loses on this, that's fine, we'll call her up. It assumes she will not take that phone call, and that the risk engine has to manage this such that that's okay. It has to manage this such that, you know, Bitcoin starts going down, that amount of collateral remaining starts to decrease, eventually issues a margin call, and it has to do that before that number goes negative. Like, it has to do that while there's still positive amounts of remaining equity value in the account, with the goal of never having any account go negative, even given no recourse, given that, like, you could never call someone up. A different model that you could have is step one, Jill puts on a position. Step two, Bitcoin goes down. Step three, you call up Jill and you say, please deposit $15,000 because that's the amount that your position is underwater right now. Model two, the risk is that she doesn't pick up the phone, right? Maybe she doesn't have any money. Maybe she would prefer to have the money than to give it to you. Many people would prefer that. For one reason or another, right? If she doesn't pick up the phone, you've got a hole in the system. You've got a $15,000 hole in the system. And, you know, that's got to be either you're paying out of pocket or it's socialized or something. The way that we try and structure it is that there's no, they don't pick up risk because we require collateral deposited beforehand. And so what that means is, yeah, there's a big market move. And in fact, some of the names that you've heard about had accounts on FTX, but like they had collateral there. And like if they refused to answer a margin call, like eventually we deleveraged their position. While they still had non-negative account equity value left. And so there's no overall contagion or hit to the system.
Would you say that like there was stressing or testing of your kind of like liquidation models during the last like month or two? And like, what did you learn? Yeah, so I mean, Bitcoin fell from like 30K to 20K at around 11 p.m. on a Sunday, I think, roughly, which is, it's not the most liquid time in the world. And so we got to see empirically, like, okay, you know, we had whatever, how many billions of open interest. Like, some of that was levered long. Like, what happens when there's a 30% market move, you know, triggered over a 2-day period, roughly? You know, I will say that I had a business trip that week. I was flying out like Sunday or Monday, and like, when I sort of got to the place, I was like, this is dumb. I should fly back to the office. Like, the market literally just dropped 30% since I like took off. Like, I need to be at work, not like dicking around here, like trying to, you know, talk with outside parties. And I sort of like called people and like, you know, looked at Slack, called people. And one of the most surprising things to me was that like, there actually like nothing was on fire in terms of like our systems. Like ultimately I did not fly back and it was fine. What would you have done? Like, would you have like hit the liquidate button faster?
Well, that was the thing. The answer is there's nothing for me to do, right? I sort of like, hey guys, can I help? And they're like, what would you do, right? And I'm like, is there anything that needs help? So like, I don't know. Do you want to buy Bitcoin? Like,
did you? That would have helped.
It would have. Well, we did have real conversations at some point about like at what point. So FTX keeps its treasury in dollars. Like, we did have conversations at some point about, like, at some point, we just buy Bitcoins, right? Like, there was a price. We did not hit that price. But we had a price in mind of, like, at this price, we will start to buy Bitcoin.
And that would have been out of FTX.
Yeah, it would have been. And, yeah, I don't, like, actually operate Alameda anymore day to day. And so it's, you know, they were sort of doing a variety of trades, the details of which I don't know. But, like, at some point FTX could purchase crypto on its own balance sheet. It's like not exactly a hedge for a business, but I mean, right, at some price, sure, right? Like,
yeah, I mean, and it's in the same vein as sort of everything else, which we've talked about, where it's like, like the nice way to put it would be being sort of pro-social to the crypto ecosystem, where like you are bailing out depositor-facing platforms,
right.
You're buying Bitcoin.
Yeah, and sort of some of this came to the question of like which needs a bailout more, Bitcoin or depositor-facing platforms? And I think our answer is depositor-facing platforms, but you could have imagined a slightly different world where the answer is Bitcoin, right? Yeah. Where like there's more sell pressure on the asset and fewer under-collateralized platforms, in which like that would have shifted that calculus a little bit there. But yeah, it's basically nothing was on fire. It sort of like worked somewhat smoothly.
And under-collateralized platforms are in the long run sort of supportive of crypto generally, or if you're bailing them out, right? Like you're getting people back in.
Yeah, getting people back in, making sure that there aren't customer losses, making sure there's some contagion that spreads through the ecosystem of like debt on debt on debt, sort of like, collapsing. And I mean, separately, I think there are like hard risk management questions that a lot of these platforms would need to ask themselves, even in the case where they're fully made it through this event. Right. But like, that's step 2, and step 1 is like stabilize, and step 2 is like think about whether this business model and this implementation of it made sense in the first place.
Yeah, I am curious, just like why people thought running 20-to-1 leverage with this model worked, and why people let them.
Yeah, well, so on the let them, again, it's not even clear you could tell as a customer what the leverage was, right? Which is a problem in of itself, but
they're like, it seems to me that there are institutional players facing places like Celsius and Voyager, and the fact that no one was like 20-to-1, huh?
Well, so the institutional players don't necessarily see their whole book, right? Like they don't necessarily know if most of their loans were over collateralized or not at all collateralized. And the platforms themselves were the only ones who saw their whole books and actually knew what those, and like, we sort of got to look at a lot of those books after the fact when we were sort of in bailout mode. But I did not know prior to that exactly what state each of these places' books were actually in to begin with. And they'll all give you pitches, which are probably a little over optimistic on average about what their real risk looks like.
So we only have like a minute left. I want to just quickly ask about effective altruism. Like one model for your kind of like utilitarian calculus is that that a lot of people want to gamble. Crypto is both a good sector for gambling and a very efficient way to extract fees from gamblers if you run a crypto exchange. And you are sort of in the business of funneling money from people who are going to use it poorly on gambling to like animal charities and pandemic preparedness and Joe Biden. Is that too cynical of you, or is that not cynical at all, or what?
I think it is too cynical. I think this is also something I've gotten more appreciation for over time. I think I sort of like had much more unformed thoughts of this earlier in my life, but I think I've increasingly come of the view that like it is, at the very least, I want to be doing something net positive, like with the making money part. Like I want to be a good actor there, and I think that like part of it is just like it is unsustainable if you're not, and has a huge number of bad flow-through effects, and is destabilizing for society to some extent. And so I think like I like am to some extent in the business of like making money and then giving it away. Like that is absolutely what I'm in the business of. But I do want to try and make sure that like that even if I think a lot of the value is created in the second step, that first step is not destructive.
On that note, I think we're out of time, but thank you so much, Sam.
Of course.
And have a good time, Sam.
Thank you.
I can tell you every other panelist is really glad that they don't have to immediately follow that session. Because it is lunchtime, and before you go to lunch, I'm going to ask all of you, make sure, do you know what your collateral position is? Because it sounds like a lot of people don't. It also sounds like some of you will be texting your compliance people and asking if moderately bad deals are acceptable. If they say yes, please call me immediately so I can write that story. Here are some instructions about lunchtime. If you have a breakout session, and you will know because you will have received emails about it, please stay on this floor. Your lunch and your rooms will be on just past the main staircase, and there will be signs and staff directing you to your appropriate locations. If you didn't get your act together and register for a breakout session, don't worry, there's still lunch. You can go down one flight of stairs, mingle, network, check out the Bloomberg terminal, and please be back here promptly for 1 p.m. We will be doing a very exciting live taping of the Bloomberg Television crypto show. So if you are here for that, please be here promptly so that you don't disturb the actual live taping. There will be cameras. It will be very exciting. And we will see you back after lunch. Thank you, everybody.